The Fed will likely move once, maybe twice this year, and obviously that has to be later in the year.
I think they go at least once. I think 2 is a good baseline, and I think there's an option for 3 if we're right about how quickly inflation slows.
They're still very much focused on eventual policy easing.
They'll move if the data warrants it, meaning that there needs to be a shock in much weaker data.
I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Heading into a week of important inflation data, and 2 of us are live in D.C. One of us is in Paris, and Surveillance family member Danny Berger and co-host for the show is in New York. Welcome to Bloomberg Surveillance. More on why we're all over the place to start the week in just a second. When you want to set up a really important week, though, that really kicks off in some ways on Wednesday with a pair of data releases that may solidify a narrative that's been flipping and flopping. Danny, I want to get your take on why Wednesday is going to be so important.
Why Wednesday is going to be so important, Lisa, is because this market has decided with the weak data coming from the consumer, whether it be sentiment, whether it be the earnings, the weak data coming from jobs moving in the wrong direction. If inflation doesn't also soften, maybe we'll start talking about the S word, stagflation.
Indeed, that's part of the fear right now. In the meantime, we are in Washington, D.C. Let's get to the why. Annmarie, you have a really important interview with Janet Yellen, Treasury Secretary, coming up later this morning at a time when industrialization and the Chinese-U.S. relationship, frankly, is what every CEO, every consumer, and frankly, every politician is focused on. What's going to be your focus this morning?
That's right. We're sitting down today, and actually she's going to be in Virginia talking about some of this money that's been flying out the door in Washington when it comes to whether it's the Inflation Reduction Act, the American Rescue Act, CHIPS. She's going to be talking about broadband, bringing it to rural Americans. At the same time, we look ahead to tomorrow in Washington, D.C. The president is going to announce tariffs going up, the walls going up when it comes to those imports from Chinese goods, whether it's batteries, EVs, solar, coming into the United States. But we have to remember, and Terry Haynes will be on us a little bit later, I think he's going to want to make this point, a lot of this is symbolic because some of these materials are not even in the United States right now.
And it also raises this question about what it will do for inflation, what it will do to the economic trajectory, given the fact that a lot of people thought that this would be something that could put a damper on certain activity. Inflation, I know you're focused on electric vehicle policy and all these other things that very much have people's attention, but inflation very much in the forefront of people's minds here as well.
Look at the consumer sentiment we got on Friday. It was a huge push lower, and when you look at what individuals in America are thinking about where inflation is going to be longer out term, in their mind, they're starting to think it's going to be higher. This is a psychological effect. And even though you have the Biden administration talking about Inflation Reduction Act, American Rescue money going out the door, they want to build up the capacity in the United States. They're talking about how they're going to talk tough on China with tariffs. At the same time, poll after poll continues to show it's inflation that Americans are most concerned about.
I love it. Basically, what we have is AMH talking to Janet Yellen today. The reason why Jonathan Ferro is not here, he's in Paris. He is going to be speaking with David Sullivan of Goldman Sachs. Very much looking forward to that. I'm here to worry about the deficit with other people who are focused on the Treasury auction. Coming up, Janet Yellen, don't miss that. Emmanuel Macron, don't miss that with John Micklethwaite, our executive in charge in Bloomberg News. And David Sullivan with Jonathan Ferro coming up later this morning as well from Paris. And a real question here about how some of these executives really do deal with some of the crosswinds that we've seen only get more significantly fraught, really. What we're seeing in markets is the longest streak of gains on the S&P going back to early February. Right now, we're starting to kind of continue it, trying to start in an upbeat up to about 0.1% on the S&P, 52, 51 at a time that some people were saying this is the beginning of a correction. What you're seeing is a little bit of dollar strength, but it's been all over the place with a bit of yen strength overnight, given the fact that Japanese authorities actually didn't buy back as many bonds as many people had been expecting. More of a downward trajectory for 10-year yields, only lower by about 13, 14 basis points from where they were at the end or the middle of April. Sort of an interesting trajectory given how much people have have pushed back rate hiking expectations. And then what we have is crude just a little higher, but had been lower last week. Coming up this week, we were talking about this, a really important week ahead, given the fact that we are going to be looking at what happens on Wednesday with a pair of data releases. We get retail sales as well as consumer CPI, which together will give you a sense of whether this is stagflation, whether this is Goldilocks, or whether this is a no landing. It is a flipping and flopping narrative. What we have today is we have some New York Fed data coming out about forward-looking inflation expectations, as well as the Fed's Messer and Jefferson. Tomorrow we get PPI. Fed Chair Powell is going to be speaking, as well as Lisa Cook. We're also going to be getting Home Depot earnings. And then on Thursday, we do get Walmart earnings, which will be key to watch, as well as a host of Fed speak. Coming up this hour, we have Cameron Dawson of New Edge Wealth and U.S. growth and the consumer very much in focus this week. Terry Haynes of Pangea Policy as the Biden administration ramps up pressure on Israel. And John Riding of Green Capital on the Fed's outlook with PPI and CPI on deck. Let's begin with our top story. The S&P 500 looking to build on 3 weeks of gains as investors prepare for a busy week of data. Cameron Dawson of New Edge saying this market continues to be all about growth. As long as GDP and earnings growth aren't being revised lower, the equity market has been able to shake off a tighter Fed and higher rates, maybe until now. Cameron joins us now. Cameron, I'd love to get your take, and wonderful to see you, on how important Wednesday is going to be to really understand whether we're in a no landing, whether we're in Goldilocks, or whether we're headed toward the dreaded stagflation.
To judge that, I think the retail sales will be the most in focus, meaning that are we still in a world where this market is able to shake off bad news and consider it good news because the Fed can bail you out? The thing that we've seen, though, is that economic surprises have really plunged over the last couple of weeks and are now in negative territory, the most negative that they've been since 2022. And of course, back in 2022, we were cutting estimates for GDP rather rapidly, which was leading to this weak sell-off within equity markets, within credit in 22. So can we still be in a world where economic surprises are weak and equity markets shrug off and move higher? We're not so sure, which is why we continue to watch those GDP estimates and earnings growth estimates so closely.
This raises this question about how close we are to the stag, to something where we could see inflation expectations stay higher, or we could see yields remain sticky, Fed expectations pushed out as they have been to maybe September, but really some more bad news getting priced into equity markets that are looking for reasons to rebound.
Well, if you're looking for the stag, really start with PMIs. That's where we saw in both services and manufacturing. You saw new orders turn down, employment turn down, the overall outlook turned down, and yet prices jumped up rather materially. And if that is a picture of the rest of the economy, then that's when you could start to see this sticky inflation, but you're not getting the growth to offset it. Now, the thing with equities I think is important to remember is that equities still do like inflation, meaning that it gives them pricing power. So of all the asset classes that can tolerate that environment, it would be broad equities. However, it then raises the question, what does the Fed do in that scenario if you have that sticky inflation, but growth really isn't holding up?
You say that you're excited about retail sales, Cameron, but how concerned are you about the consumer sentiment data we got last week, the lowest we've seen in 6 months?
Yeah, consumer sentiment has been one of those where it's watch what they do, not what they say, meaning that consumers have been able to spend, even though they've been reporting very sour outlook about what they're thinking about the economy and their forward outlook for incomes and overall financial situations. But are we at the point where consumer sentiment is picking up on moderating real wage growth? That's really important because we have seen wages moderate, yet inflation is staying sticky. So where real wage growth has been recovering for much of the past year, it's starting to stagnate. And we think that's one of the reasons why consumer sentiment turned so much lower last month, is that consumers are feeling the pinch from inflation. They're starting to lose purchasing power again, and they're feeling pretty sour about it.
So what kind of equities do you want to be exposed to if that's the environment we're preparing for?
Yeah, we still really like large cap, high quality equities because you get the combination of a few things. You get good balance sheets, which means that they're able to deal with higher for longer better. In the smaller cap areas of the world, you have balance sheets that have more floating rate debt and a big refinancing cycle, which just means that the balance sheet can get pinched if the Fed isn't cutting interest rates. But in the large cap quality part of the world, you also have pricing power and good return on invested capital. So what we look at is that across sectors, we're looking for those highest quality names at the top of each sector that have the ability to navigate this environment, even if it means a more challenging one than the one that we've been in over the last year.
Cameron, I feel like we're setting up the week really well in the sense that we're very much focused on what happens Wednesday with the economic data. We are in Washington, D.C. Danny's in New York. What we're dealing with John over in Paris is global CEOs trying to basically act as the ambassadors for the United States at a time of really uncertain foreign policy. How much are you watching some of the tariffs that are coming out, some of the policies that really are hewing more to the industrialization side in the U.S. to really make investment theses?
Yeah, I think we have to see the counter of it, which is that on the one hand, we have tariffs, which can certainly disrupt supply chains, but we also have huge fiscal spending. You mentioned the rural broadband, things where we're starting to see a lot of spending that is flowing down to a lot of industrial names. Now, the real peculiar thing is, to bring it back to PMIs, is that we've seen a huge surge in manufacturing, construction, and all of this fiscal spending, but it's not showing up in PMIs and broadly being enjoyed by the broad manufacturing sector. So in that sense, what we think is that you continue to have this push-pull between tariffs as well as fiscal spending, which just creates uncertainty and disruption, but good companies should be able to navigate that.
Which raises this question on the other side, and I haven't explained why I'm here. I'm actually here to worry about the deficit. I'm here because basically you have a lot of people who are getting together from the Congressional Budget Office, from Wall Street, to wonder how much we have to care about an unprecedented debt load in this country and when it's going to actually start to bite on interest rates. Do you worry about that? We heard last week from Steve Eisman that, the deficit people are just wrong, and they have been for the past 30 years. Are you among the the deficit people who are watching for this to actually trickle into some of the pricing in the next couple of months?
It's certainly one of those things that it's not a problem until it is. And we would look to the bond market and the long end of the bond market to price in some of that stress or uncertainty, because, of course, we saw that in a very short window last year when Treasury really increased coupon issuance, and we saw Treasury yields in the 10-year sell off really rapidly. When we think about going into the election, the biggest takeaway that we have is that neither party is talking about austerity, which means this is so very different than times of high deficits like coming out of the great financial crisis, where, of course, in 2010, you had the Tea Party and you had the Budget Control Act, which really was an effectuation of a lot of austerity pushed by voters. So it doesn't seem to be a priority for voters, which is why we don't think that we're going to hear much from either party, which means get used to higher coupon issuance, get used to higher deficits, because it doesn't seem like either party wants to push austerity.
We're going to be talking about that throughout the day, throughout the year, so you've got more to look forward to. Cameron Dawson of New Edge Wealth, thank you so much for being with us to kick off this week. And that's what we heard certainly over the weekend from Donald Trump in terms of not really exactly an austerity push, Annmarie.
No, it's not going to be an austerity push, regardless of who's in power. I think this is what people are starting to realize. Next year, this is what David Malpass last week told me about, this perfect storm. You have another debt ceiling fight. You have the perennial fiscal spending fights in Washington, D.C., but also the tax era Trump cuts. They're going to expire. What does that mean for the deficit?
Probably what we're going to get is more tax cuts that are announced, at least based on some of the rhetoric that we heard overnight. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. Amazon, Pfizer, Microsoft, and Morgan Stanley are among the companies poised to boost their presence in France. President Emmanuel Macron will host 180 CEOs and executives for the Choose France Summit. The flagship event, now in its 7th year, is part of a push by Macron's government to attract foreign companies and make it a financial hub for the post-Brexit European Union. Donald Trump pledged to double down on tax cuts if he wins a second term as president. Speaking at a rally in New Jersey this weekend, Trump said, quote, "Instead of a Biden tax hike, I'll give you a Trump middle class, upper class, lower class, business class, big tax cut." President Biden has called for tax hikes on businesses and the richest Americans. And campus protests over the war in Gaza are colliding with college graduation season. Comedian Jerry Seinfeld was the commencement speaker this weekend at Duke University, where about 30 students walked out chanting Free Palestine and waving flags when he was introduced. But Seinfeld didn't address the protests. A small group of demonstrators also showed up at UC Berkeley's commencement on Saturday, but the university says the protesters left voluntarily and no one was arrested. More schools have threatened student protesters with arrest or expulsion if they don't clear out pro-Palestinian encampments ahead of graduation ceremonies. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Blinken issuing a strong warning to Israel.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas.
That conversation coming up next. You're watching Bloomberg Surveillance.
Earnings season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Under surveillance this morning, Tony Blinken over the weekend going the rounds on a number of different shows, issuing a strong warning to Israel.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas. We've been talking to them about a much better way of getting an enduring result, enduring security, both in Gaza itself and much more broadly in the region.
Here's the latest. U.S. concerns growing as Israel increases its Gaza offensive. U.S. Secretary of State Antony Blinken warning of a post-war Gaza still armed with Hamas militants, risking insurgency. Blinken adding that Israel has not presented plans for the enclave's future. Terry Haynes of Pangea Policy joining us now for more. And we did see Tony Blinken, good morning to you, really making the rounds throughout the weekend, talking about how there is a question of whether there have been some humanitarian violations, but they continue to have full support for Israel. Was there anything conflicted in your view about the message from the Biden administration?
The message of the Biden administration is nothing but conflicted, I think. Secretary Blinken, no disrespect, what he had to say in your bumper, he could have said and probably did say 6 months ago. They all certainly need an exit plan. The United States, among other things, is being very coy about, what the better way is. But beyond that, every participant in the region will want to know two things. Firstly, what is that plan? There are three things. Secondly, is it feasible? Thirdly, will the United States stick to it? 20 years ago, President George W. Bush issued a bunch of guarantees in that region that were systematically stripped away by the Obama administration and not followed up on by the Biden administration. I'm not saying that to make a partisan point. I'm saying that to say the United States needs to get in there, stick in there, and in order to become a full partner, needs to move things forward, not just with Israel, but with the region as well.
How much of this is because of growing domestic pressure on the Biden administration?
Oh, some of it, certainly. I'm not going to, Lisa knows I love percentages, but I'm not going to assess one on this one. But I'd be foolish to say there's no politics involved in a decision that has a political dimension. But at the same time, what you have is a situation where, there's too many cooks in the kitchen, I think. The president looks muddled, and at a time when what the United States needs both domestically and for foreign policy is clarity.
We're moving closer to the election, less than 6 months now. Domestic pressure when it comes to the youth vote, when it comes to what's happening in Gaza. But also tomorrow, the president is set to unveil the sweeping tariff hikes on a number of whether it's EVs, solar, batteries coming in from China. You say all of this is noise. Why?
Well, I say it's noise for a couple of reasons. One is that, tariffs already exist, so cranking down tariffs is not exactly, the biggest news in the world, although the markets will take it as a negative signal. Secondly, what I think is what markets may miss is that you have a situation where it's not just about tariff policy. It's not just about chips. It's not just about, a few things that the administration and Congress are doing to try to meet Chinese competition. What we're sliding into here now is a situation where either administration, either a Biden administration or a Trump administration, will deal much more forthrightly to shore up the defense industrial base going forward. And I think that's a signal that you get out of the tariffs decision, but one that markets may miss.
Well, this raises this question of how much more capacity the United States to do this, given the fact that some people worried about the deficit. And we do have this concern about the increasing sizes of auctions. Is there a sense that there is the capacity in the budget to really increase spending on defense, increase spending on CHIPS Act and things of that nature?
Well, the politics in Washington aren't coherent on this. I mean, you've got two political parties, one that basically denies the deficit's a problem, the other one which wants to pretend they're dealing with a deficit problem by cutting 1% out of the 30% of discretionary spending. So neither party is particularly serious on this. So what you're going to get, as your previous guest Cameron talked about, and what you all talk about a lot, is that you're going to get deficits into the far future. And, neither Biden nor Trump is going to be able to fix this unless you get a situation where there's an all-red Republican sweep in Washington, which I think is at best about a 30% possibility. It's not my base case, which is Biden and a split Congress. What you get is a situation that's pretty much like the status quo. People won't care about deficits, but they'll throw as much incentive as they possibly can at building the defense industrial base even more.
This is going to be pivotal next year because there's the debt ceiling fight, but there's also the potential extension of the Trump-era tax cuts. Trump basically says he's extending all of them across all board. He said that over the weekend. The Biden administration is interested in extending them for some, but they want to raise the corporate tax rate.
Right.
Do you have a base case of what potentially will get through Congress in terms of the extension of those tax cuts?
The base case will be a lot closer to the Biden case than it will be to the Trump case, because unless you have, everybody remembers in 2016 that Trump's election was greeted with euphoria, which was not exactly a base case with a lot of analysts, right? But it wasn't Trump. It was Trump plus an all-Republican Congress, because they knew the path to the 2017 tax bill would be a lot smoother. That's not going to happen this time. As I say, that is not the base case. Base case, I think, is Biden still squeaks through. Even if Trump wins, you're probably going to end up with a split Congress. So, those speed bumps, to do something like Trump wants about the 2017 tax law won't exist, frankly. Democrats will dig in.
Well, what kind of corporate tax rate do you think we could see? Because I'm pretty shocked that some Republicans are saying, actually, we don't want to lower it to 21%. We think it should be higher.
Yeah. My gut is, and it's instinct only, is that you look at something like 23, 24, 25%.
The Joe Manchin route?
Yeah, kind of. The soundings I get is that, corporate's not only a relatively small part of this, but that corporate believes they can deal with a small uptick in corporate rates. And it's the personal rates that are the big problem and that are the big deal. And, when I was doing this in a previous life, the question I asked our economist essentially was, how low can you get the personal tax rates? Increase the deficit by how much? And it was basically, you can get them to 20% if you increase the deficit 1.5 trillion over 10, which sounds like a lot, but it's not, right, in Washington terms. And then, so that became the bogey like a year out, and that actually happened. So, I would look at a small uptick in corporate, but at the same time, I would look at in a Democrat split Washington, I would look for more taxes on the wealthy.
Just in this whack-a-mole Washington that we've been playing this morning, what's the number one question that your clients are asking you heading into the election?
It's really what the effect on the economy is going to be, very simply. Like, what do you think? A lot of the things we've just talked about.
And basically, you look at them with a blank face because it is very unclear what effect it's going to have on the economy other than bigger deficits.
It'll have a mitigating impact, but will it be large? I don't know. But the move towards a more defense industrial-based incentive from Washington, I think, will cause more roiling than is now anticipated.
Terry Haynes, wonderful to see you. Terry Haynes of Pangea Policy joining us here in Washington, D.C. Always wonderful to hear from you. Coming up, Bloomberg's Michael Shepard on the race to fund chip production and higher tariffs aimed at China. All of that coming up. And, of course, do not miss our conversation with our own Annmarie Hordern with Janet Yellen coming up later. It's going to be a great interview.
We're going to be talking about some of those themes Terry just mentioned.
Yeah, and get her sense on exactly what the threshold will be for them to amp up some of the rhetoric and action. From Washington, D.C., from New York, from Paris, this is Bloomberg Surveillance. This is Bloomberg Surveillance heading into a fourth week, potentially of gains, at least based on where we are. We are in Washington, D.C. I'm alongside Annmarie Hordern. I'm Lisa Abramowicz. John Ferro will not be with us today or tomorrow because he will be interviewing David Solomon of Goldman Sachs. Later this morning, Annmarie Hordern is going to be speaking with Janet Yellen. Right now, what you can see in markets is trying to rally yet again after 3 straight weeks of gains. You can see that gain really starting to increase just a bit more, 52.53 on the S&P, up 0.1%. NASDAQ futures up more than 7% since the end of April 19th that week. We could see that continuing, 0.2% gain there. What you could see in the bond market, and this to me has been one of the most interesting plays that we've seen, given the fact that people are pushing back expectations for a Fed rate cut to potentially September, yet really got a dose of cold water poured on some of the optimism of some of this Goldilocks type of environment. Last week, Annmarie, we saw this fact that potentially inflation expectations creeping higher, even as people's sentiment coming down, raising the prospect of stagflation or yields that can stay a bit higher for longer, even with some of the deteriorating sentiment.
This is what David Malpass, former head of the World Bank, was talking about yesterday. He joined us here in Washington, D.C. Very different vision of how, say, the Treasury Secretary Janet Yellen and the White House view where this economy is going. But then Friday, you get this consumer sentiment report, the lowest we've seen in November, and how people are starting to view inflation as a bigger problem. Remember, prior some of these consumer surveys, people are starting to worry about the labor market. But again, it's inflation once again that's top of mind.
Which raises this question for the dollar. We saw that streak of dollar strength, and a lot of this was predicated on the idea that the U.S. was going to be cutting rates last and way after a lot of the other central banks. A question now of whether that's true and what other central banks are doing to mitigate it. What you could see right now is a little bit of dollar strength. The euro, you could see losing just a little bit. But what's more interesting is what's happening over in Japan, given the fact that we saw the Bank of Japan decline to buy as many bonds as people previously expected. Yields at the longer end of the yield curve in that country rising to the highest going back to 2011. A question on what other central banks can do to offset, and not just central banks, but fiscal authorities can do to offset this idea that the U.S. has been in an exceptional place.
The U.S. is exceptional, although Peter Cheer, and I know he's going to be talking to you later.
Actually exceptional.
Yeah, he's questioning it. But when you talk about the yen, it's the weakest out of all G10 versus all G10, the yen's the weakest, and they continuously try to prop it up, and it's not working. So until they look at monetary policy, it's a great question. What can they do? It's very difficult to fight U.S. exceptionalism at the moment.
Unless it's not really exceptional enough, and we will talk to Peter Scheer about just some of the potential cracks under the surface. Under surveillance this morning, traders preparing for a busy week of data, PPI on Tuesday, CPI and retail sales, the difecta on Wednesday, jobless claims on Thursday, plus another look at the consumer with the earnings from the Home Depot and Walmart. More interested actually in Walmart even than Home Depot, since it's potentially a read on how much people are downshifting. But Annmarie, very much to me, the idea that we get the 1-2 punch on Wednesday of both CPI, Consumer Price Index, does it come in hotter than expected, which really sort of threatens this Goldilocks type of disinflationary narrative. And do we see retail sales come in significantly, given the fact that it's just getting more expensive and harder for consumers?
CPI on Wednesday, our survey is showing 0.4% increase. Is that what the market is expecting? If it is hotter, how much more challenging is that going to be the Fed? And does that change the narrative on these cuts? Does potentially 2-1 baked in now become maybe 0? And how does that happen even potentially before the U.S. election? Well, but to your point, retail sales and what is Walmart, Home Depot, what are they telling you? I go back to what Mohamed El-Arian said. What everyone missed in that transitory view of 2021 was they weren't listening to CEOs in the earnings calls saying that inflation is still in our pipeline and we're still struggling with this.
But some companies still raising prices, which is the reason why people are concerned about what this means. Very curious to see also about the reaction function from the Federal Reserve when we get a host of Fed speak this week, potentially about how they're going to deal with the fact that growth might be slowing and inflation is not really coming down as quickly as people would like. Meanwhile, and this is something that, Annmarie, I know you have a lot of insight on, Russia's President Vladimir Putin, with a surprise shakeup in leadership. Putin appointing First Deputy Prime Minister Andrei Belousov to replace Defense Minister Sergei Shoigu. Shoigu will take over as Secretary of Russia's Security Council as Putin looks to grow the country's war machine against Ukraine. Really interesting, since Shoigu is such a stalwart supporter of what we saw in Ukraine, given the incursion, replacing him with an economist. How do you understand this?
So this has to really go down to the idea that Putin probably is thinking that this is going to be a long, protracted war, and they want to make sure they are shoring up the economics of being able to fight that war. And there's been some frustration from the Kremlin with Shoigu, but they are moving him to a top position. Now he's going to become the head of their National Security Council. This is the post Nikolai Patrushev has been holding. I think what was more stunning yesterday was the fact that Patrushev has been dismissed from this job. We still don't know yet, though, where he's going. So Peskov came out and he said that he will go somewhere, and they'll announce that in the next few days. But this is a long-time Putin ally. And it's just interesting to see that they're pushing him to another position. We don't know yet. So we're not sure whether it's a proper, potentially, if he's being really ostracized from the small circle Putin keeps around him, or potentially it's going to be something even closer.
I also wonder, though, if there's a signal here, and that's, I guess, what a lot of people are wondering, is how much can we understand maybe more of a focus on the economic damage of the incursion in Ukraine, or is this just, an indictment of some of the failures on the battlefield that we heard from the Wagner Group and we heard from some others? Do we have a sense of that, or that's some of what people are going to be parsing through?
I think that's part of it. There has been issues on the defense front. I mean, you saw what happened with Yevgeny Prigozhin and how he took on Shoigu. There have been issues within the Russian military apparatus, but at the same time, this is classic Putin. He loves keeping everyone on edge, and he does from time to time like a big shakeup.
And that seems to be what we got overnight. Meanwhile, Bloomberg reporting that the U.S. and the European Union have spent $81 billion toward the next generation of semiconductors. This is the first wave in an expected $380 billion set aside globally for the industry. And this week, the White House is expected to unveil increased tariffs on key industries between the U.S. and China, including Chinese electric vehicles. Bloomberg's Michael Shepard joining us now. Shep, we've been talking all morning about the electric vehicle tariffs. I know that Annmarie is going to get into that with Janet Yellen later this morning, among other topics. We haven't talked about what Terry was talking about, which is the increased spending on defense and industrialization, the defense military complex. How much is increased chip spending almost a part of that?
Well, chips are essential to everything all around us, but especially in the military area these days. From the legacy chips that go to power some of the more sophisticated weapons that are being deployed on the battlefield, to some of the more advanced technologies such as AI that the military is hoping to deploy. And all of that is really sensitive, and it is part of the defense intelligence and technology base that the Biden administration is trying to build up, also in tandem with the Chips and Science Act.
This reverses a long time where outsourcing really was welcome in terms of getting things cheaper. And we've seen this shift going back a number of years where we've really removed some of this technology from China. How much can we measure any efficiency? Can we measure any potential added benefits from every country going it alone? Or does it feel like potentially a lot of waste and thrown money at something that worked a lot more efficiently before?
That's a great question, Lisa, because you're really getting to the heart of what comes from all this spending. What is going to be the fruit of all this investment from governments globally? And we are not going to know for a decade or perhaps longer than that. It takes so long to build one of those chips plants, get it under production, and then you have to see what the market actually bears. Right now, the trend with the push in AI and all these other advanced technologies like quantum computing indicates that we need many more chips than we can make right now. And then also on the security front, we were just talking about Russia, but the China question does loom over investments in chips as well. What will happen with Taiwan? The Pentagon has indicated that China would be ready to undertake an invasion of the island as soon as 2027. So that is overshadowing the U.S. thinking on its preparedness. Right now, the United States doesn't make any advanced chips in this country domestically. The goal of the administration, Gina Raimondo has said herself, by the end of the decade, they want 20% of the production of those most advanced logic chips. And that will be a big leap. And it will depend on the ability of companies like Intel and even TSMC through facilities that are being built now in the U.S. through this CHIPS and Science Act money to deliver that capacity.
Is the Chip and Science Act in jeopardy if Trump wins?
That's a great question, Annmarie. And one of the things that we'll have to watch is how it gets implemented. While the money has been promised to a lot of these companies, about 85% of the grants have already been at least parceled out on paper to companies like Intel and Micron Technologies. But one thing we haven't seen are the actual checks. You see, the companies have to go through this phase of due diligence. They have to meet a whole series of milestones and promises to get the next round of actual funding in their bank account. So it will take some time. And then whether the administration, if it is a Trump presidency, continues with the same vigor in that direction, it's a great question.
Let's talk about what we do know, which is tomorrow Biden's going to be hiking tariffs or keeping some tariffs the same on a number of key sectors of these goods coming from China. I have some reporting about what that means for EVs. Now it's going up to a 102.5%, even though there's not a single EV right now, a Chinese EV in the United States. What is noise and what is real that comes out tomorrow?
Well, I think it's both noise and real. And the noise part is the impact in the moment. Because as you say, Annmarie, right now, exactly, it's symbolic. We don't see any Chinese EVs driving around on the streets. You can't go to a BYD dealership to pick up your Chinese-made or Chinese-branded electric vehicle. But the administration is trying to stave off future imports of these Chinese products because the government in Beijing is really making a big push to invest in this industry. And the administration here is concerned that that will lead to a flood of imports here and disadvantage American makers. And then there is also the data security question, too, that they keep bringing up. The EVs gather up so much information, and they're concerned about where that goes.
Yeah, the heavy lifting that national security has done. We talked about that extensively. Can you explain to me, we're talking about tariffs, we're talking about increasing the barriers for electric vehicles coming into the U.S. from China. And then on Friday, Zeekr Intelligent Technology IPO'd. This is a unit of the Geely automotive company over in China. Electric vehicles, a higher-end version of them, coming to the United States. And basically, people loved it. People couldn't get enough of it. It popped 35% in the first day of trading. What gives?
Well, people were drawn to the technology. And it was interesting during the interview, the executive seemed unfazed by the prospect of these tariffs.
Short-term noise.
Short-term noise, or maybe looking at markets elsewhere, outside the U.S., where that, his products may actually gain a foothold and leave the U.S. market out.
Which raises this question again about Paris and John Ferro, who's off in Paris and is going to be speaking with David Solomon as all of the executives try to lobby in different places right after that travel from Xi Jinping over to the region. Bloomberg's Michael Shepard, thank you so much for being with us. Always wonderful to see you. Let's get an update right now on stories elsewhere this morning. Here is your Bloomberg brief with Yahaira Haques. Yahaira.
Hi, Lisa. Sticking to China, U.S. officials intend to highlight security concerns with China's development of artificial intelligence when they meet tomorrow in Geneva. The meeting will jumpstart talks agreed to last year by President Biden and Xi Jinping to address security and safety concerns over AI, even as the two countries intensify their competition in that space. Xiaomi is pushing ahead with plans to make an SUV similar to Tesla's Model Y. It comes as the company is approaching full capacity and is working on increasing output to satisfy demand as it looks to compete in China's crowded EV market. The company plans to begin making and selling the new model as early as next year. Disney's Kingdom of the Planet of the Apes took in $56.5 million to top the domestic box office this weekend. That was more than the up to $50 million projected. This marks Disney's first release of a new film in theaters this year. Other big-budget Disney pictures due out this year include Pixar's Inside Out 2, Marvel's Deadpool and Wolverine, and Moana 2. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Heated debate here about, wasn't Planet of the Apes made in like 1962? What year?
1963.
Oh, sorry. Totally off. This is the issue. Is this sort of the new playbook is just make movies that were made previously, make them again?
As Yahira's talking about it, I'm like, they made a new one? Isn't that old? What's old is new again?
Oh, yeah. And then we can get Steve Eisman on to comment on just what the review is and who they killed off. Annmarie now is heading off for a really important interview with U.S. Treasury Secretary Janet Yellen. Do not miss that. I am so excited to hear about it. Were you guys going to be in a field or something?
We are going to be in rural Virginia, where she's going to be talking about the expansion of broadband to rural areas. That's her big pitch today. And actually, I got a fact sheet from the White House today. The entire week is going to be filled with White House aides or cabinet secretaries going out for ribbon cuttings. All that money and that legislative agenda, they want to see it being put to work.
It sounds like it is infrastructure week here in Washington, D.C.
It is.
And it has been for a while. Up next, the stubborn last mile for inflation.
The Fed and investors alike are looking for meaningful reprieve in inflation, but unfortunately, I think they're going to have to continue to wait for some time longer.
That's coming up next. You're watching Bloomberg Surveillance. Welcome back. This is Bloomberg Surveillance. Under surveillance this morning, the stubborn last mile for inflation.
The Fed and investors alike are looking for meaningful reprieve in inflation, but unfortunately, I think they're going to have to continue to wait for some time longer. My base case is that inflation remains stubbornly elevated, well above the Fed's 2% target through the end of the year, keeping the Fed then potentially on hold through the entirety of 2024.
Here's the latest. Investors looking ahead to a full slate of economic data this week, including CPI, that key one, on Wednesday. John Riding of Breen Capital writing this: as inflation approaches 2%, the Fed should dial back restraint, but 2 cuts into September and December would probably just keep policy at an unchanged degree of restraint in 2024. There is the recession scenario, and then cuts would be more rapid. But this is probably a 2025 story if it happens. Let's head up to our New York studio, where Danny Berger has been patiently waiting and listening, and is joined by our very own John Riding is joining our very own Danny Berger. Danny.
I was going to say, Lisa, I'm enjoying listening, but sure, I'll take the reins from here. I am joined by John, helping us set up a very busy and potentially pivotal week. Let's start with Wednesday. Higher than expected data in the first quarter for inflation. Does that continue this week?
Well, that's one of those things that we're going to have to find out, right? My own view is that there is what we have referred to as residual seasonality in both the GDP accounts, which has made GDP quarter to quarter appear weaker than it actually is in the first quarter, and the inflation data higher. So I do think there is a good chance that we're going to see a number that ends up being neither fish nor fowl. If we get the 0.3% on core CPI, that is excluding food and energy, that will be a little cooler than we saw in the first quarter, but not cool enough to be at 2%. But the problem is, for me, and when it comes to thinking about the Fed, is they haven't really laid out their methodology for beginning to lower rates. Because if we get rate cuts in 2024, and I think we still get 1 or 2 rate cuts this year, it will be a different kind of rate cutting than the Fed has typically done in the past.
And this is something you've been writing about, that they haven't distinguished between cutting rates and an easing cycle. So what is the difference, John?
Well, it's massive. So this concept, real interest rates adjusted for inflation, right? So the Fed's target funds rate's 5.25% to 5.5%. When the Fed started hiking rates, when rates were essentially at zero, and the inflation rate was taken off, real interest rates were very negative. Now we've moved to positive real rates. Now, if inflation continues to decline and the Fed leaves interest rates unchanged, then real interest rates will rise, and the Fed will actually be tightening policy. But it will be tightening policy as inflation heads towards 2%. Now, the tighter policy is, the faster should be the fall in inflation. So the Fed, what the Fed risk doing is undershooting here. Now, the problem is the markets, and in part this is Powell's problem in the past. When the Fed starts cutting rates, we typically cut by 5 percentage points.
Right.
So when he even talked about rate cuts in December for the first time, the market priced in 3 or 4 more additional rate cuts to the 3 that they already had priced in. And it's really because the Fed hasn't. And I think there's room for a very important speech, at least one coming from someone at the Fed, to lay out this next set of policy adjustments. Because right now the Fed's hands are tied. And they're partly tied because they underestimated the inflation problem back in 2021.
Well, this is the thing, John. It's, as we say, frequently we hear on the show, there's a difference between what the Fed should do and what the Fed will do. So if we do get cuts and they don't properly communicate what you're saying, that this is sort of a mid-cycle adjustment, is there not the risk for the market to overshoot how much the Fed is going to ease? And then you get these animal spirits back that, yet again, contribute to too much inflation.
I think that's what you're referring to here, particularly as easing of financial conditions, is a major thing for the Fed to be concerned about, particularly given where the equity market is right now. If you'd gone back and said, in early 2022, well, the Fed's going to raise rates 5 percentage points, where's the equity market going to be? I don't think anyone would have had it anywhere close to where it is right now. So the Fed is going to be concerned that its rate-cutting intention is misperceived. And, it's very difficult. And I think what might help is when the Fed starts talking about the long-run interest rate, which the Fed still has pegged at 2.5% in its SEPs, they either get rid of it and say, hey, we don't know where it is, or they adjust it more to where markets are currently priced.
To get back down to 2%, because again, as you say, that is what the Fed has pegged it at. Mohamed El-Erian has been writing about this, that you would need to see serious damage in the economy, and therefore it's not worth actually trying to get back down to target. Is he right?
I actually, while having great respect for my, we were both at Cambridge University pretty much at the same time back in the late 1970s. Well, I actually respect him. I think he's wrong on this one. I think what the data have shown so far is that you can have disinflation without destroying the economy. And it is absolutely worth squeezing inflation out for that last mile. And it doesn't have to be a quick disinflation. It can unfold over time. But again, it comes back to the Fed giving an important speech saying, hey, this is how we see monetary policy working. And this is, I believe the Fed is absolutely intent on getting inflation back to 2%. And this is how we're going to do it.
Well, some folks have said that it's some signs of slowing in the consumer that turn into cracks, that turn into something worse, that brings inflation back down. When you have reports from individual companies, Starbucks, McDonald's, saying consumers are starting to be worried, how much stock do you take of that, especially heading in to, again, tomorrow, Wednesday, when we're going to be getting some of those retail data coming in, and then we're going to be getting earnings from the likes of Walmart and Home Depot?
Well, we get the retail sales report on on Thursday, and that can be pretty important release. But the consumer has seen their savings rate fall. We're now at a savings rate down at 3.2%. That's actually relatively low by the recent history. But consumers also still have a massive amount of wealth in relation to income. So, we're in relatively uncharted territory because apart from when spending was shut down and people were getting income injections from the government, and so the savings, up to $2.5 trillion of unintended savings accumulated during the pandemic. Apart from that, we've never had wealth in relation to income at this high a level. So it's very hard to go back and you'll be relying on models that have not actually experienced where the data currently are. But in the end, when it comes to the fate of the economy, it's not about the consumer. It's about whether companies make money and then hire people and then invest. And that's the dynamic process. Then they hire people, people get wage income, and then they spend that wage income. So for us, changing our recession call and taking the recession out of the central case for this year was not about the consumer, and the consumer's doing very well. It was about companies where we haven't seen that squeeze in profits as inflation has come down. So we've had what economists and I thought was skeptical could happen was this immaculate disinflation where inflation's come down, but we haven't seen profits squeezed and we haven't seen the economy pushed into even a sharp slowdown, let alone recession.
John, perhaps just a touch of heresy to say it's not about the consumer, but it's good to get that view. John, thank you so much for joining. I'm afraid that's all we have time for. That is John Writing of Green Capital. Lisa, and again, I think this idea that John was talking about is fascinating, that the Fed needs to be making clear that this is not a typical rate-cutting cycle. It's more of an adjustment to get the restrictiveness of policy back in line with what inflation's doing.
Insurance cuts, something like cosmetic cuts, things of this nature. Bloomberg's Danny Ryder, a wonderful interview with John Writing of Green Capital. Thank you. Coming up next, we have Troy Gajewski of FS Investments, Bloomberg's Mario Parker, NYSE President, New York Stock Exchange President Lynn Martin, and James Athey of Marlboro Investment Management. From Washington, D.C., from New York, from Paris, you're watching Bloomberg Surveillance.
The Fed will likely move once, maybe twice this year, and obviously that has to be later in the year.
I think they go at least once. I think 2 is a good baseline, and I think there's an option for 3 if we're right about how quickly inflation slows.
They're still very much focused on eventual policy easing.
They'll move if the data warrants it, meaning that there needs to be a shock in much weaker data.
I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Heading into an important week for inflation. From Washington, D.C., for our audience worldwide, good morning. This is Bloomberg Surveillance. I'm Lisa Abramowicz. Annmarie is off to do that interview with Janet Yellen. John Ferro in Paris. Danny Berger in New York. We have a massive week coming up of key inflation data, starting tomorrow with PPI, that factory input prices. Also, Fed Chair Jay Powell is going to be speaking. But Wednesday really is the key day where we get a 1-2 punch of both the CPI print, the latest reading on just how fast consumer prices are increasing, plus retail sales. How much is this diminishing the consumer's ability to spend? The expectation is inflation is going to remain stickier than the Fed would like, but retail sales, while declining, should hang in there. We will get that check. We'll also get that check with a host of earnings, including from Walmart. And then throughout the week, we get a sense of initial jobless claims, which came in higher than all previous expectations last week, suddenly having something that is something that we're actually focused on. How much of a noisy report was that? Right now in markets, you could see trying to add to 3 straight weeks of gains, which has been the greatest, this longest increase going back to the beginning of February. Just a little bit of a gain, just climbing as the session grows older, up about 15 basis points, 52, 54. The dollar just strengthening a touch. We have seen that, although really curious overnight with the Japanese yen strengthening on the heels of government officials not buying back as many bonds as people previously expected. Yields very much in focus, and this goes to the reaction function of how does the Federal Reserve deal with the idea of inflation that remains stickier than many people are hoping for, even while growth starts to slow down. Crude very much a wild card also, as we have that 13 million barrels a day being produced in the U.S., but a lot of geopolitical concerns and noise about how OPEC Plus will be responding. We are scattered all over the world today. We have Annmarie and myself in Washington, D.C. We have John Ferro in Paris to do some key interviews, including David Solomon, the president and CEO of Goldman Sachs, chair and CEO. We also have Janet Yellen coming up with our very own Annmarie Hordern, U.S. Treasury Secretary, and Emmanuel Macron, don't miss that, the president of France, who is being lobbied by everyone far and wide, whether it's bank executives or Xi Jinping of China last week. And we will have that sit down with John Micklethwaite, our own head of Bloomberg News. Coming up this hour, we're going to be speaking with Troy Gajewski of FS Investments, and we're going to get to that in 1 second. But Danny Berger down in New York, and I'm wondering how important it is to get a sense of the latest inflation read and how that informs a narrative that has been flipping and flopping. We have gone from no landing to Goldilocks to now we're talking about either stagflation or hard landing. What is the point of Wednesday and why it's so pivotal?
Which, by the way, it could flip-flop again, Lisa, depending on how retail sales come out after that, and then could flip-flop again depending on how Walmart and Home Depot do in their earnings. But it's important for this bond market. This is the stat from Liz McCormick that made sense intellectually, but still shocked me. Of the 60 basis points moves we've seen in treasuries this year, Lisa, half of them have come from CPI days, because we haven't been set up for the idea that inflation would be higher. We got one data point. We said that was one. We got a few more. We said it was a month. We got a few more. We said it was just a quarter of a blip. Is it still a blip, Lisa? Can we say that when we've had the entire first quarter of hot readings? Wednesday is going to go a long way to show us that.
And then at what point does the Fed change the bar? And this is something else that we've been talking about, given the fact that you see, for example, from Austin Goolsbee of the Chicago Fed coming out over the last couple of days talking about how, well, it's going to be sticky because, frankly, rents take a long time to go down. And that's going to be lagging behind some of these forward indicators like consumer sentiment. So we will find out the reaction function. How much is this Federal Reserve willing to look past some of these harder than expected inflation rates in order to get a sense of just whether they need to prioritize growth or whether they need to prioritize fighting inflation. We've got more on that coming up. Danny, cannot wait to get to it. Coming up this hour, we've got Troy Gajewski of FS Investments with stocks coming off 3 weeks of gains. The NYSE president, Lynn Martin, will be speaking with Danny Berger on the potential for 24/7 trading. I'm sure a lot of people are looking forward to not having evenings or weekends, although it's not like many people have full free time anyway. And James Athey of Marlboro Investment Management with a look at PPI and CPI on deck. Let's begin with our top story. Stocks holding steady ahead of a key week of economic data. Troy Gajewski of FS Investments writing this: we're in an interesting transition period for the economy as the labor market continues to evolve from previously white hot to red hot to closer to warm. Troy joins us now. Troy, can we just get a sense, and thank you for joining us, of why we're having such a difficult time reading this when it's clear that consumers are running out of savings, they're pushing back more against higher prices, they're being more selective. So it is something that shows slowing. How do we know exactly how much they're slowing down?
Well, I think to start with, you always have to analyze any investment strategy from a standpoint of sensitivity to outcomes. So, you shouldn't be dependent upon whether the Fed has to keep rates high throughout this year or cut 3 or 4 times for a successful outcome. But to your point, I think the reason for the flip-flopping we were discussing before is so many of the economic models are maybe a little overly fixated on financial conditions. And that's why when financial conditions tightened so much in 2022, a lot of the probabilities that those models were spitting out were close to 100% recession probability when the consumer was still in incredibly good shape and the labor market was white hot. And then we got to a situation where financial conditions loosened as much as they had. And then many came out and said there's really no chance the Fed cuts at all this year. And our point is that, we've been steadily transitioning from this white hot labor market to then a red hot labor market to right about warm right now, whether you look at JOLTS, initial claims that have come up recently and the recent non-farm payroll report. So there is progress, but at the same time, super core inflation, owner equivalent rents have been very, very sticky, which means the Fed is going to be very patient with their cutting cycle.
Are they, Troy? This is one of the key questions. Can they be patient with a cutting cycle at a time where that might be a lagging indicator? And some of the forward-leading indicators point to what we've seen traditionally during downturns, which is the labor market doesn't turn slowly. It doesn't sort of have this gradual progression, but it's all of a sudden, and it's a sharp decline in the ability of people to get jobs.
Yeah, no, it's a great point. Great question, Lisa. I think, saying this time's different is obviously very dangerous, but clearly, the path that we've gotten here is very different than previous cyclical downturns. And again, we have been steadily transitioning, whether you look at JOLTS, whether you look at initial claims, whether you look at NFP. And when you think about what it would take to really drive a meaningful enough surge in unemployment, it would really take corporate profitability dropping dramatically. And yes, there are some debt service coverage ratios in certain floating rate issuers out there. And yes, interest expense has gone up enough. But corporate profit margins have re-expanded back to record highs. And then you look at other contributors to GDP, whether it's state and local government spending, whether it's business fixed investment. It's very difficult to find one of those subsectors of growth that could roll over enough to cause that sudden surge. So, our whole point this whole cycle is it's going to be the mirror image of the 15 to 18 hiking cycle. the Fed is going to be very patient, and we don't see any data to indicate that they're suddenly going to have to cut by 4 or 5 times by the end of the year at this stage.
It's really well how you frame that, and I'm glad that you did. And this has sort of been the conundrum where you see a lot of lack of confidence among Main Street. But on Wall Street, things look great, and companies have been able to hang in there, and they've been able to deal with lower consumer spending by just raising prices. And they can actually get away with it because people have enough money and they have jobs so they can continue to spend. At what point, though, is there a flashing red signal that you have to take from small caps? When you take a look at that, and that's been in recession for a long time, tried to recover, gotten beaten down, and lagged behind until there's this hope of maybe sooner rate cuts. There is a question here. How much of a probability do you price in of a hard landing at this point?
A hard landing? Yeah, so you can never exclude it completely, but when most people define hard landing, that means, in our view, somewhere between 1 and 2% GDP contraction. And again, to your point, and I'm glad you brought it up, the consumer is in a weaker situation today than a year ago when, there was far more excess savings left. The labor market at that point was somewhere between white, hot, and red. And as one of your guests brought up earlier today, savings rates have run down to the low 3%. So there's less shock absorption capability. But the probability of a hard landing where the Fed has to cut, 100, 200, 300 basis points in response, at this stage, the only thing that would cause that would be some type of exogenous or endogenous shock. And, when you think of endogenous, it would be some type of treasury market accident. When you think of exogenous, it could be geopolitical or another type of pandemic situation. But again, there's nothing clear that says, hey, suddenly states and local municipalities are going to have to cut spending by 5%. Or, oh my goodness, you look at business fixed investment, corporate profitability is at record highs. You have this massive AI boom. Suddenly they're going to cut business fixed investment by 10 or 15%. For what reason? So very, very unlikely. Not a 0% probability, but let's call it 10% or lower at this point, Lisa.
Troy, I know that given all of this, you've been pretty positive on stocks. You've been considering that there's going to be this sort of stickiness to rates where they are, given the fact that the Fed is unlikely to cut. I know you've liked agency mortgage-backed securities. You did just add a trait, and that is the consolidation of small and regional banks. Why is now the time to start thinking about that, given all the questions around what's going to be allowed? What has changed for you?
Yeah, so great question. When you think of the past of the banking system, right, a lot of people forget we have close to 10,000 fewer banks today than we did back in 1990. So you've had, this mega trend of bank consolidation. But within that, there have been periods of very tepid consolidation. And then there have been periods of massive consolidation like the late 90s, like the follow-on from the global financial crisis. And what we're seeing today, in our multi-strategy fund, which again is solving for consistent returns with low beta, low duration, and low volatility, is that because of the regulatory pressure on regional community banks to clean up balance sheets, and because operating costs have gotten more and more expensive, we'd expect a mini bump in consolidation in regional community banks, not to get to the point where regulatory scrutiny becomes overly burdensome, but to the point where you can squeeze out operating efficiencies. So, that is a beta neutral expression. There's a basket of 20 to 25 smaller banks that we expect to potentially be taken out. And then we take out the beta, basically using the KRE to neutralize it. So if there is some type of shock that you talked about, the downside is very, very limited. So, the next 6, 12, 18 months, regardless of political outcomes, we expect consolidation to continue. And then if there's a transition in D.C., perhaps there could be even more heightened activity.
In other words, you're saying that if Donald Trump is elected, you think that could actually increase mergers and acquisitions across the board?
Well, I think if you look at M&A broadly, the FTC has been pushing back very hard, as you know. That strategy right now is basically pricing in 20 to 25% of deals breaking, when historically it's only been 5 to 10. And it's very clear because we've had a very aggressive FTC. If there is some type of political transition, perhaps the FTC is less aggressive on that front, and that would lead to more consolidation like we saw during the first term of the Trump administration.
Troy Gayeski of FS Investments, thank you so much for being with us. As always, great to get your insights. Right now, let's get an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. U.S. Secretary of State Antony Blinken issuing a warning saying Israel risks fueling a Hamas insurgency in post-war Gaza. He cautioned that there will still be thousands of armed militants in the area, even if Israel invades the city of Rafah. The Israeli military estimates that over the past week, 300,000 people have fled Rafah in southern Gaza, which was once a haven from Israeli bombardments in the north. President Biden is set to announce heavy new tariffs on Chinese electric vehicles this week. A source says the tariffs will quadruple from under 30% to over 100% and will include other key exports, including batteries, solar cells, steel, and aluminum. Biden and his staff have spent recent weeks finalizing the measures, but the plan is seen as largely symbolic as China doesn't rely on U.S. consumers for the targeted sectors. And Amazon, Pfizer, Microsoft, and Morgan Stanley are among the companies poised to boost their presence in France. President Emmanuel Macron will host 180 CEOs and executives for the Choose France Summit. The flagship event, now in its 7th year, is part of a push by Macron's government to attract foreign companies and make France a financial hub for the post-Brexit European Union. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Everyone trying to get up. Who is the next London? Up next, Biden clamping down on Chinese electric vehicles.
The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else.
That's coming up next. This is Bloomberg.
Season is here.
This is a get out the popcorn moment.
An across the board just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Heading into potentially the 4th straight week of gains on equities as people push back their expectation, yes, for bring forward some of the expectations for a Fed rate cut, but also deal with a potential weakening in the consumer. Welcome back. This is Bloomberg Surveillance. We are seeing that lift continue to gain up about 0.2% on the S&P. You could see yields lower by about 2 basis points, 4.48 on the 10-year. 2-year yields and 10-year yields down about 13-14 basis points since the end of the week of April 19th, with a question of how much more can they fall, given that inflation has not come in. And we are going to be seeing that key inflation read on Wednesday with CPI, consumer price inflation, given the fact that the Fed is very much focused on this metric, potentially at the expense of a weakening economy. Under surveillance this morning, Biden clamping down on Chinese electric vehicles.
They're not competing. They're cheating. They're cheating. And we've seen the damage here in America. The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else because we're investing in America and American workers again.
Here's the latest. President Biden is set to quadruple tariffs on Chinese-made EVs, setting levies over 100%. This week's announcement will also target batteries, solar cells, steel, and aluminum, according to people familiar with the matter. Bloomberg's Mario Parker joining us now. Mario, what do we know about whether these are announcements of tariffs going into effect now or plans for tariffs at some point down the road?
There'll be plans for tariffs at some point down the road. Some of the details are unclear right now in terms of some of the rates. We know that some of them will be quadrupled, tripled, doubled even. We know that EVs are a prime sector that the president will be targeting as well.
Are there any EVs here currently coming into this country from China?
That's a great question. No. And so largely, a lot of this is symbolic, right? We know the climate, the political tenor toward China right now from both parties. The other part of this is practical. The practical part is to head off some of these imports that could come and flood the market as Biden tries to build out the domestic electric vehicle market here in the U.S.
How much meat is there behind this? There's a question, first of all, you can tariff things that aren't coming into the country, or you could go after places like Mexico in terms of production or parts that are coming from China that might be going into other vehicle manufacturers. How widespread is this net?
It's pretty widespread. I mean, it's targeted toward China, right? The point that you hit on is the point that former President Donald Trump, who's running against Biden, tried to square in on Saturday, saying that, well, China could essentially go around some of these tariffs, build some of these products in Mexico, and then ride the coattails of the USMCA, a trade agreement, in order to still circumvent some of these tariffs. It's unclear right now whether or not that'd be possible.
Is there any pushback from any party right now against the sort of greater industrialization and moving away from any kind of U.S.-Chinese trade ties, even if they actually are happening in the same number, even just through some sort of intermediary company? But is there this sense that there is no voice pushing back against that?
Well, there are some voices in the industry, right, who are dependent on some of these products to come through. That's one point. But the other part is, in this very hyper-polarized Washington, D.C., the consensus that you do see, the rare consensus that you do see, is just a stance toward China, right? Think of the TikTok bill a few weeks ago. You can't get any type of bipartisanship agreement on anything until it comes to some of the geopolitical issues with China.
But this raises a question not just about China, but also just in terms of allies. And if you're trying to focus on U.S. production, you're trying to focus on bringing things home and beefing up the industrial sector, how much is that alienating, say, France, which just had a visit from Xi Jinping saying, hey, our door is open and our things are on sale?
And you see some of this light pressure, right, from the Biden administration on the European allies. You're hearing some rhetoric from Donald Trump on a much more aggressive pressure that he'd put on the European allies should he win a second term. His catchphrase in all of this is essentially, we want to have competition with China worldwide, right? Allies and all, but we don't want to decouple. So he's trying to toe this delicate line. And that's the realization that a lot of the allies are still reliant on China as well.
We're here this week really focused on inflation. Inflation very much the forefront here in Washington, D.C. as well, within a Financial Times poll coming out showing that about 80% of voters see inflation as really their number one issue and really dampening prospects for Biden if it doesn't come down further. How much do we have a sense about the contribution of tariffs and some of these walls that are going up, how much that will have on inflation?
Well, that's one of the criticisms that the Biden campaign and Democrats lobbed toward Donald Trump's plan to essentially increase tariffs ad hoc around what Donald Trump calls a collar around the country. They're saying that, well, his stance would go a bit too far and add to and further fuel inflation. The Biden administration's stance with all of this is essentially that it's targeted, that it won't hurt American consumers.
This is a very difficult sort of circle to put a peg into, and there's a question here as we go forward. Are there independent analyses that you're trusting? What's your lodestar right now in the spin cycle that we're in, given the fact that everyone's going to use everything as a way to try to say the other guy's wrong and bad, even though it's a very complicated time where it's unclear what the right answers are?
Yeah, well, some of the think tanks, I think, here in Washington, D.C., and then some of the investment banks that we rely on as well with their research reports essentially have some of the more sober views, right? So we haven't seen a whole lot, again, in terms of inflationary pressures that this will put. The consensus so far is that largely this is symbolic. To your point earlier, there aren't a lot of Chinese EVs here. This does maybe head it off. That's still kind of political speak. But in terms of just how much this will affect the economy right now, a lot of these things, solar cells, aluminum, steel, EVs, they've already been largely shut out of the market from China.
Although solar, there are some potential caveats, there's potential carve-outs for solar panels in the U.S. This is something the Biden administration wants to ensure, given the fact that industry members have actually lobbied them and said, we actually need those parts, please. And this is something that's part of the green agenda that Biden has. Do we have a sense of how integral Chinese products are to the Biden agenda of a sort of clean energy plan?
This is the tough part, right? Because his landmark legislation, the Inflation Reduction Act, which essentially seeks to remake the green economy, you're seeing some of the solar industry participants saying, hey, well, some of these components that we need to make some of these solar panels in order to enact this legislation that you've put forth, we actually do need some type of carve-outs and workarounds to allow China to import here.
Do we have a sense of how much of that agenda Donald Trump would unwind if he came into office?
Sounds like all of it, because Donald Trump, I think there's no secret about it. He's not a fan of green energy. Just as recently as Saturday, he was railing about wind farms as well, saying he would sign an executive order on day one to roll back anything that gave incentives to wind farms. He rails against solar. He's more the traditional carbon-based president should he win a second term.
Love that. Railing against wind farms, or at least the subsidies for them, not just saying, wind farms, down with wind farms. Bloomberg's Mario Parker. Thank you so much for being with us. Coming up, you don't want to miss this, New York Stock Exchange President Lynn Martin coming up to talk about all things initial public offerings, as well as potentially nonstop trading for stocks, something that everyone has been looking for on a weekend where they're with their kids. Well, you could be trading too. Right now, you are seeing that lift continue up to 0.1%, potentially a fourth straight week of gains if it holds. Good morning. Welcome back. We are in Washington, D.C. Annmarie has a wonderful interview with Janet Yellen, Treasury Secretary, coming up later this morning. John is in Paris. He's going to be interviewing David Sullivan of Goldman Sachs. Right now, we are looking at what is going on in markets, which is another potential day of gains following 3 straight weeks of gains. That is the longest advance going back to February as people reset their expectations that bring forward maybe some of those Fed rate cuts that previously had been pushed off, potentially off the table even for 2024. Meanwhile, we are focused very much on what's going on in the tech sector. We've been speaking all morning about semiconductors and some of the industrial complex that the U.S. and its allies have been pumping money to in a competition with China. And what we are looking at next is the iPhone and what they're doing with potentially not only their chip suppliers, we've been hearing about them building their own chips and things of that nature, but how they're going to incorporate artificial intelligence more closely with their phones, given the fact that has been the next wave of innovation. The next operating system of that iPhone is set to include ChatGPT, with Apple close to a deal with OpenAI to bring artificial intelligence to the company's flagship device. Bloomberg's Alex Webb joining us now for more. And Alex, that's where I wanted to begin, this idea of what exactly does this mean?
Well, it means that if this thing goes through, Apple should be able to compete more readily with Google's operating system for mobile Android, right? Google is very much at the bleeding edge when it comes to artificial intelligence innovations. Apple, to be frank, isn't. And so if everybody in the next few years is really going to be looking for AI capabilities in their smartphone, they need to have some sort of offering, and it looks as though that's going to come from ChatGPT.
This raises this question about what kind of financial arrangement there's going to be, who has the data, how much this is going to be a sort of intricate relationship between the two at a time where Microsoft already has a key investment in OpenAI. I'm losing track of all of the threads here, Alex. Can you help me?
Yeah, so you've got OpenAI, which is very closely aligned with Microsoft. Google has its own captive research arm, Google DeepMind, which is merged with Google Brain. Amazon has a growing relationship with Anthropic AI. Apple is a little bit out of the picture here. Now, the thing that Apple has been trying to do with its AI innovations so far, and there is some AI stuff in your iPhone, is to do it on the device, right? What happens at the moment with OpenAI, with ChatGPT, is that you pose a question, it pings that up to a cloud, the cloud then does all the thinking and issues your response. That's all well and good when you're trying to ask big, complicated questions. Write an analysis of today's news as a sonnet. What Apple's perhaps more likely to do is get the real functionality, setting a timer. What's the weather like in New York? And then a follow-up question, which will be able to understand, oh, these are the same question. It should be able to do more of that on the device. It'll be really interesting to see how that pans out. The kicker, of course, to processing this stuff in the cloud, it costs something like 12 cents for every 1,000 words it has to process. That is not nothing. And that's why we haven't really seen these AI chatbots come into everybody's virtual assistants just yet.
And we have seen year-to-date Apple shares down about 5% versus that more than 10% gain from Microsoft, Alphabet, Google up almost 21% year-to-date. So Apple lagging behind. You need to get on the ball. There's a question about also just how big of a shift this is going to be with artificial intelligence in our phones. I mean, does it really transform our lives in this meaningful way? Some people saying that it will be a material shift that will cause people to upgrade and buy phones. Other people saying if you have a better Siri, is that really a game changer?
I think it's, look, Siri may not be the place that it's really making a big difference. It's in these other parts of your life where, when you're writing a letter, when you're putting together a CV, you might increasingly be getting it to plan your evening for you. I think in a few years' time, we will notice that it is actually relatively well embedded in our lives, and we won't really have noticed. It will have just been a steady evolution to that point. The thing that is quite interesting is you've seen a few small AI-powered devices, the likes of the Humane Pin and the Rabbit. They have not been terribly well received by reviewers. A lot of people have been saying, well, yeah, I can just do most of this with a smartphone already. You already have ChatGPT on smartphones through an app which you pay for. So they are already there. It's just a question of how deeply integrated they are, how much of the other bells and whistles in your smartphone these AIs will have access to and be able to control.
Just quickly, Alex, how much does this set up the conference, the developer conference that a lot of people are watching for in terms of some sort of new innovation being announced?
Yeah, this is really the thing that people are looking for with a great deal of attention, investors and users alike. Worldwide Developer Conference in a few weeks' time. That is where they unveil what's going to be in the next operating system for a phone. And seeing how far they've come in the time, because they've had to accelerate pretty quickly into AI, will be really important, not just for users, but for the stock.
Bloomberg's Alex Webb, thank you so much, as always, for that. Meanwhile, the Financial Times reporting that the New York Stock Exchange is surveying market participants on round-the-clock trading. The survey, coming as a startup backed by Stephen Cohen's Point72 Ventures Fund, is seeking SEC approval to launch the first round-the-clock exchange. Let's head to New York, where Danny Berger is joined by the New York Stock Exchange president, Lynn Martin, to talk about why we all need 24/7 trading in our lives. Danny.
Hi, Lisa. That's right, because, we want to be wrangling the kids and have the ability to trade while we do so. Hi, Lynn. Thank you so much for joining us.
Thanks for having me.
So some others might have opinions about this, but overall, the survey that you've gotten so far, from what you've heard, I know you're still in the middle of it. What have you heard?
So far, what we've heard is there are a lot of things to consider, mainly on the infrastructure side, which is not really a surprise. It's why we sought out to get feedback before something like this was introduced by the SRO community. We wanted to understand all of the pieces of the ecosystem that would need to fit together if we're going to introduce this responsibly. So the feedback so far hasn't really surprised us. There's a lot of parts of the value chain to consider.
So realistically, if you did want to do something like this, how long would it take to actually set up that type of infrastructure?
Well, there's a variety of things that would need to be considered. Most importantly, we would need to talk to our regulators about it, not just us. Our clearinghouse, DTC, would also need to consider that with the regulators, to the extent that they would remain open for that 24-hour trading.
It's interesting because there does appear to be demand here. Lisa mentioned Steve Cohen's venture wants to do something like this. Do you have any sense of idea of where that demand is coming from, the type of person that wants to be trading 24/7?
So I don't know that it's really 24 hours a day. I think what has started most of the demand, what's really triggered most of the demand, has been the rise of the ETFs. And if you look at the basket in some of the ETFs, particularly the international ETFs, they're not just securities that are listed on a domestic exchange. So from a risk management standpoint, it would make sense that you would want to manage your risk in the underlying baskets when those domestic markets are open.
Fair enough. Now, Lynn, when it comes to IPOs, we started this year. You and many folks were excited for 2024, that it would be a big year. So many people's hopes have been dashed. I think the volume is somewhere still near a decade's low when it comes to IPO volume. Are you still hopeful for this year?
I absolutely am. And actually, I'm incredibly optimistic given the amount of proceeds that have been raised so far in the markets. $14 billion so far has been raised in the U.S. markets through last Friday. We've had about 25 operating company IPOs on the New York Stock Exchange. That's 2 times the amount of proceeds raised year to date versus last year, and 3 times versus 2022. So the markets are definitely opening up. And what I'm personally excited about is those companies we've welcomed have not just gotten large deals done. Many times they have upsized their deals. They've priced either at the high end or above the range. And then they're seeing that pop, the 20% pop when their stock opens. So it's been a really exciting, particularly Q2, really exciting time where we're seeing about 2 IPOs a week at NYSE.
Well, Reddit is a great example of a company
Absolutely.
that IPO'd, a lot of fanfare around it, but a company like Reddit, it's a mature company. It's a quality company. Investors feel safe with it. Is there room for anything outside of that?
So you have seen some more growth-oriented companies go, but importantly, as you mentioned, they've had a path to profitability. So I think that's really what is getting valued. It's why those companies that either are profitable or have a path to profitability are getting rewarded. You look at a company like Viking, which is the largest IPO of the year. It's a household name. I had so many people say to me, I can't believe this company isn't public already, given that many of us have enjoyed their cruises, whatever the case may be. But then you've also got great companies, emerging companies around cyber like Rubrik, who just IPO'd on us a couple of weeks ago.
Even with the uptick in demand, Preqin data came out that there's still $3 trillion of money tied up in aging companies that haven't gone public. There still is this impetus to stay private for longer. Are you concerned with, as companies stay private for longer, that they found alternative paths to going public and just that norm that we used to see, it's not going to get back to that?
I'm not really concerned because there is no match for the U.S. capital markets in terms of an efficient form of capital and attaining that capital that you really need to scale your business, not just from that perspective, but also rewarding employees, democratizing investment, M&A. M&A is a big reason that I hear some of these companies going. They believe that there's a different M&A currency that you get with becoming a public company versus staying private. So I continue to be incredibly optimistic. However, people are going to be more thoughtful about when they go public. I don't think you're going to see a rush to the public markets like you saw in 2021 for quite some time. But importantly, I think we're out of the 2022, 2023 closed IPO markets.
Is there a chance we get back to that rush, and what needs to be in place for that to happen?
Well, it feels like, we have the capacity to have a pretty normal year. If we've raised just over $14 billion to date, in an average year, you raise about $45 billion in the public markets. We're not too far off. And based on what we're seeing in our pipeline, I think this could be a pretty close to normal year.
How much of that depends on the Fed cutting? Is that necessary?
I don't think it's necessarily dependent on the Fed cutting. I think people are getting used to this concept of there's a little bit of uncertainty in the markets. The big concern you had over the last 2 years was the hard landing versus soft landing. And I think people feel pretty good about our economy. So I don't know that it matters if the Fed cuts once, not at all, whatever the case may be. But I do think you'll probably see a little bit of a closure of the IPO markets around election time, like you have in any other election year.
Fair enough. And going back to some of the things you mentioned of why the American IPO market remains strong despite some of the wobbles, things like the liquidity, the investor base, it's made it a global destination. But there was this report that Shein, the Chinese fast fashion company, wants to list in London instead of the U.S. because of the regulatory environment. Is that global beacon that the U.S. going to change with the U.S. regulators that are more intent on cracking down in China?
I don't know about that. I mean, I can't really speak to the conversations that a prospect like a Xi'an has had with our regulators. I do hope that they're able to enter the U.S. markets, but it will be up to our regulators to determine how.
Okay, Lynn, we're going to have to leave it there. Thank you so much for joining. Really great to see you. That is Lynn Martin of the NYSE. Lisa, with that, I'll send it back to you.
Wonderful interview, Danny Berger there with the NYSE president, Lynn Martin, talking about all things IPOs and whether they do get off the ground. Some interesting news from HSBC coming out, making this point that I think is important just moments ago, that with the U.S. CPI in focus, if we get an inline print of about 0.4% of an increase, that will be considered a beat. Inline is the new beat, and you will probably see a rally at risk assets. That's the view from the team led by Max Kettner over at HSBC. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Russian President Vladimir Putin making a surprise change to his defense and security teams. Putin replaced his long-serving defense minister with his former economy aide and first deputy prime minister. The ouster of one of his closest allies may reflect frustration at the failure to defeat Ukraine in a war that was meant to last for days and is now in its third year with hundreds of thousands of Russian troops killed or wounded. Campus protests over the war in Gaza are colliding with college graduation season. Comedian Jerry Seinfeld was the commencement speaker this weekend at Duke University, where about 30 students walked out, chanting Free Palestine and waving flags when he was introduced. But Seinfeld didn't address the protests. A small group of demonstrators also showed up at UC Berkeley's commencement on Saturday, but the university says the protesters left voluntarily and no one was arrested. More schools have threatened student protesters with arrest or expulsion if they don't clear out pro-Palestinian encampments ahead of graduation ceremonies. And Tesla is facing further protests at its factory in Germany, where activists are trying to stop an expansion that would require clearing a large swath of the surrounding forest. Police say at least 16 people were arrested on Friday following actions, including breaking into an airfield, damaging new Tesla vehicles, and blocking a road by the factory. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the U.S. risk of stagflation.
If the definition of stagflation is elevated inflation in an era of slower growth, yeah, that's very possible.
Meanwhile, that is coming up next. We are seeing markets continue with their lift, with HSBC saying that they are expecting the dip in risk assets to be behind us. This is Bloomberg. Heading into that key CPI print, the key response is going to be, how does a market react to a CPI print that's expected to continue to have a reacceleration a bit from the final quarter of 2023? However, at least not accelerating more than people previously expected. What we're set up for right now is with gains, with what we hear from Max Kettner at HSBC. More might be in store, up to 0.1%, carrying on and building on the gains throughout the morning at session highs. As people assess the three straight weeks of gains we're just coming off, we are seeing yields lower, down about 2 basis points, 448 rounded up briefly at 10-year yield, as people push back the expectation of a Fed rate cut to September, but not necessarily taking them off the table. Under surveillance this morning, the U.S. risk of stagflation.
If the definition of stagflation is elevated inflation in an era of slower growth, yeah, that's very possible. But if you want a definition of stagflation of, 5, 6, 7% inflation with contracting growth, that's an extreme definition that I don't think we need to go to just yet.
And that was something that Jay Powell laughed at when he spoke about it at the latest Fed conference. Here is the latest. Treasury yields holding steady ahead of a key week of economic data. James Athey of Marlboro Investment Management saying the CPI print is a big one for the near-term direction of markets. But, quote, it will be broad growth and labor market stats over the next few months, which will have a more fundamental and lasting impact on where markets head next. Last month's reports screamed stagflation. And nobody wants that to continue, even if Jay Powell says he doesn't see the stag and he doesn't see the deflation. James joins us now. Congratulations on your new post, James, coming from Aberdeen. I am curious about why you think that the longer-term growth trajectory is going to matter more than inflation at a time where the Fed has said this is a dual mandate and they very much intend to bring inflation back down to 2%.
Yeah, hi, Lisa, and good to be back. Thank you very much. Obviously, the two are interlinked, right? Ultimately, all of the models that sit behind modern central bank thinking tell you that there is some linkage between, growth relative to potential, what that means for the labour market, and ultimately where inflation pressures will be over the policy horizon. So looking at inflation and jobs today is telling you a little more about what was happening in the economy yesterday. So when we see the most real-time stats that try and give us an indication of where the economy is heading with respect to broad growth, that has or should have some signal value for where those key metrics, jobs and inflation, will be in the future. So you can't really disentangle the two unless, and that's where Jim Bianco's definition of stagflation is interesting, unless you get an utter breakdown of the Phillips curve type relationship. And actually, stagflation was the description used to describe that situation when it happened in the 70s. And the reason I say nobody wants that is because there are lots of macro environments which are either good for bonds or good for equities. In a stagflation world, it is good for absolutely nothing.
And when you talk about the breakdown of the Phillips curve, it raises this question. All morning, we've been talking about industrial policy. We've been talking about the potential for government spending, as well as tariffs and blocking off traditional trade routes. Could that in and of itself create a more inflationary pressure than maybe the labor market dynamic would otherwise suggest?
Yes, I mean, the historical analogue for that sort of protectionist international trade policy very much goes back to Smoot-Hawley and tariffs, which did create significant problems many years ago. I think deglobalization just generally, a lot of people would suggest that is a secular inflationary force because it's really the flip side of the global push to outsource manufacturing to the lowest marginal cost region of production, and that has seen the price of these manufactured goods declining pretty steadily over the last 30 years. So absolutely industrial policy will play a part. I think the extent of it, the time horizon over which it occurs is relevant, because to me the question is it an inflationary process, or do we see a step change in the price level which would be different from the point of view of what we experience in the economy, but also what it would mean for monetary policy?
How are you positioning in terms of how this shakes out and where the Fed's reaction function really is in terms of sticky inflation, even with growth that is clearly souring and consumers that are clearly cooling some of their spending?
Yeah, I mean, it won't surprise you too much, Lisa, to hear that I'm on the slightly miserable side of the outlook. That I still believe that we are in an end of cycle dynamic. I'm not a huge fan of the word sticky. It's become, I think, a bit overused. There's a difference between the speed with which disinflationary pressures feed through into various aspects of the consumer price basket and genuinely sticky inflation. I think sticky historically is a word which was more applied to prices. Prices and wages tend to be sticky. That's not the same as sticky inflation. If prices and wages don't change, then inflation will tend to zero. So I think one of the reasons that we haven't seen a really rapid disinflation is because actually economies have held up better than a lot of people, myself included, thought they would. All that we've really seen is a global supply shock that has seen inflation rise and then the flip side of that, inflation come back down. I think as and when, as I expect we will, we see the economy slowing more broadly and we see more significant softening of the labour market, that's when we'll start to see the more cyclical disinflationary pressures. So I still think we're in a world where yields look attractive, duration is attractive, the timing of that's going to be quite difficult. So we are, happy to lean into weakness in the bond market and increase our duration position as we look further into the future and expect the end of cycle to hit more significantly.
Speaking on the slightly miserable side of things, I'm here in Washington, D.C. to host a panel having to do with the deficit and the fiscal overhang of debt. And this has raised a lot of hand-wringing and, the deficit concerns about the potential for rates to go up materially higher than you would expect based on inflation and even Fed's rate setting. Do you buy into that idea that we're going to see some sort of bond market disruption in response to profligate spending that doesn't seem to be ending anytime soon?
No, I mean, it is one of those concerns which is out there. I think the problem is that politicians to a pretty significant degree have learnt the wrong lessons, have been given comfort which is not necessarily something that they should or could rely on far into the future. Obviously, central banks have played a part. They've grown their balance sheets significantly in recent years, and that obviously has taken duration out of the market. That's allowed governments to run deficits which are, much higher than we'd expect given the stage of the cycle. And we saw in the UK that if you push too far, you can just reach that tipping point where other dynamics kick in and things start to look really messy really quickly. The flip side, obviously, is Japan has been apparently on the precipice of that situation for 30 years, and they've never quite reached that tipping point. So it's definitely a risk. It does concern me that there is sort of bipartisan support for having no real fiscal discipline whatsoever. But I suspect that, it's the economy stupid. The economic forces and pressures will ultimately tell for the bond market. And that means that, yes, we're likely to see supply being a constant. But I think, again, as other cyclical assets become less attractive because of how expensive they are and the deterioration in the economic outlook, that should improve the demand picture for bonds commensurately.
James Athey of Marlborough Investment Management, thank you so much, as always, as we look forward to a question of what's going to win out, retail sales that may come in weaker than expected, or CPI, which is expected to come in at 0.4% at a time where the Fed is looking to bring overall annual year-over-year inflation down to 2%. Coming up, Peter Scheer of Academy Securities on how he likes his exceptionalism exceptional. Apollo's Torsten Slok talking about these economic reports as well as the fiscal deficit. And Bloomberg's Sam Fazeli and Sonali Basak. From Washington, D.C., from New York, from Paris, this is Bloomberg.
The consumer clearly is slowing, but I don't think they are collapsing.
You should see some rebalancing in consumer spending. I'd expect a better, sort of more balanced mix to growth going forward.
A lot of people talk about that the consumer is going to slow. What the consumer will do is they will keep spending this cycle.
What's good about the consumer is that there's low unemployment and there's still spending power. What's bad about the consumer is that it's still bifurcated.
Clearly, at some point, you're going to see those defaults pick up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
From Washington, D.C. for our audience worldwide, good morning. This is Bloomberg Surveillance. I'm Lisa Abramowicz. Annmarie off to interview Janet Yellen. John off to interview David Solomon of Goldman Sachs. I am here in D.C. to moderate a panel on the fiscal debt because I care about bond auctions. And right now we are setting up for potentially what could be a fourth straight week of gains. We're coming off 3 straight weeks of gains. It is just Monday and it is just open before the trading. But you are seeing those gains continue as people assess the idea of a Federal Reserve that is looking to potentially cut rates sooner than people previously thought in the face of growth that seems to be slowing and a consumer that showed some real questions in terms of consumer sentiment at the end of last week. You can see this S&P futures up 0.25%, extending gains 59. Yields marginally lower, but coming back from earlier action where you could see a more significant decline. And this is the push-pull right now in markets. Danny Berger in New York. Really, this to me is one of the key questions. How does the Fed respond given the fact that we are seeing slowing growth? We're seeing a consumer that's clearly running out of power. And yet at the same time, inflation has been sticky with things like rents and car insurance really hanging in there. And some people say lagging behind some of the more current indicators.
Right. Well, things like rent and housing, they've been lagging behind for what, a year and a half? When is this thing finally going to catch up, Lisa? It feels like it isn't. But the reaction function, I think you're right. It is so important because Powell himself set such a high bar when at the press conference, he laid out the scenario of inflation still above what they want, not seeming to come down. And he said, well, if that all happens, it means that we're less likely to cut. He could have said it means we're going to hike, but he didn't, Lisa, which brings us to this idea. Is this a Powell put? Is the bar really that high to start talking about hikes again?
I love the Powell put is back on the table, given the fact that this is not one, Jay Powell, that wants to hike rates. We are coming up for a week that really is really landmarked by Wednesday. We get the pair 1-2 punch of both retail sales as well as CPI coming out. The expectation is for a month-over-month read of 0.4%. Just to give you some perspective, you could see a 4.5% annualized pace of CPI in the first 3 months of this year versus 3.3% of an annualized increase in the fourth quarter. That is the acceleration that has people concerned. Meanwhile, we do get a host of Fed speakers today, Mester and Jefferson tomorrow, Jay Powell, and then Kashkari and Bowman coming on Wednesday with a slew of earnings. And this goes to the question, and Danny, you've been really good on this in terms of how much is the consumer pushing back on pricing or absorbing them because they still are able to borrow at a time where card spending, if you look at Bank of America, for example, you are seeing people still spend even on the lower tiers of the income bracket.
Yeah, not even just on cards, but buy now, pay later. People using that has absolutely swelled, which does tend to be the lower income brackets. But Lisa, I really just have this nagging feeling. What happens if retail sales data comes in strong? But we hear from Walmart and Home Depot, and they tell us what everyone did earlier a couple weeks ago, that the consumer is weak. It feels like we just keep getting this conflicting data. And what happens if at the end of this week we say we still don't understand where the consumer is?
I have a feeling that's probably a base case, Danny. What we've seen so far, and frankly, something that is pretty typical during changes in cycle where people don't understand exactly where things are headed next, and that noise can be a signal in and of itself. Here's what we have for you coming up today. Peter Scheer of Academy Securities and what he says could be a bumpy landing. Apollo's Torsten Slok ahead of a host of data this week, and expectations the Fed will not cut rates this year. And Bloomberg's Sonali Basak as Archegos' Bill Hwang faces life behind bars. What I want to let you know just for the rest of the day at 10 a.m. we're kicking off an incredible line of coverage with Annmarie interviewing Janet Yellen, Treasury Secretary, as we do expect those electric vehicle announcements from the Biden administration potentially tomorrow. We're going to be hearing from the president of France, Emmanuel Macron. John Micklethwaite of Bloomberg will be interviewing him. And then David Solomon, Goldman Sachs chair and CEO in France, with our own Jonathan Ferro later on this morning, as there is this question of, frankly, U.S. executives as the new ambassadors to the world as they get out and try to navigate some interesting geopolitical crosswinds. We begin with our top story. The S&P 500 looking to build on 3 weeks of gains as investors prepare for a busy week of data. Peter Scheer of Academy Securities writing this: I think we are near the end of the lower yields Fed put rally that has helped stocks creep higher on anemic volumes. Last week, we argued that the market might, quote, gap from no landing to some form of bumpy landing. Peter, I'm pleased to say, joins us right now. It seems like we're at some sort of precipice of narrative shift. Is that kind of how you see it?
Yeah, and I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months ago. You've seen it in the City Economic Surprise Index, which encompasses a fair bit of data. And yet all you heard was American exceptionalism, American exceptionalism, American exceptionalism. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now. And Friday's consumer confidence was certainly a shock to anyone who thought everything's still rosy.
Well, this is the reason why some people are looking at this idea of maybe not Goldilocks, but a landing, which will at least bring the prospect of Fed rate cuts back on the table. Why do you see it as something more pernicious than that this weakness is maybe more entrenched?
One, we've all been asking for the last year and a half, when does the consumer slow down? When does credit card debt, all these things start, impending, stopping their spending? I think we're seeing some of that. Again, what I found really striking about consumer confidence on Friday is University of Michigan publishes both by Democrats and those affiliated with Republican Party, and the Democrat Party side went down precipitously as well. It's down below 90. So that struck me. It's, there's this party as we're heading to the election. People seem very depressed on both sides. They're worried. I think that kind of accelerates. We'll get a lot of information about sales. And the big thing to me is equities have already had this Fed put rally. So I think we've priced in a lot of Fed put type narrative. We're not going to get that many cuts, even if they cut.
We were speaking to Cameron Dawson of New Edge earlier this morning, and she said she's actually more interested in retail sales than the CPI print, maybe because of what you're just talking about. Would you agree with that? Is that sort of how you view things?
Yeah, I think there's a decent chance CPI will come in lower than expected. Just all the way the calculations are done. We probably get a brief rally both on bonds and stocks on that. But it really comes down to what's going on with the retail, what's going on with consumption, what's going to happen, I think, with trade tariffs, right? If we're going to put on more tariffs on China, how do they respond? And I think we have just started this trade war and it's accelerating. And what we're going to see is more and more margin pressure as Chinese brands try and compete both in China, but also across the globe, not necessarily in the US. But I think that's where there's going to be margin pressure. There's going to be competition with these Chinese brands. That's not yet priced in at all. And I think tariffs, if we announce this week, will make that more clear to people. Hey, we've got to be aware of this. And it's changing how the world global economy is behaving.
Well, I want to get to that in 1 second. This has been your thesis for a long time. That's been really prescient, which is basically this is a glut of goods, and the Chinese government's going to try to flood the rest of the world with stuff that they're overproducing because they structurally have to, because their economy relies on it. It's sort of the new housing market is a new industrial overproduction. Before we get there, though, I want to just have you respond because you seem in direct opposition to what HSBC's Max Kettner is saying. What he put out this morning, the dip in risk assets is increasingly in the rearview mirror as many major equity indices have reapproached their year-to-date highs, talking again about Goldilocks, that essentially some of these pressures that you're talking about are going to keep the Fed cutting on some sort of trajectory that will allow things to keep chugging along. Why do you think that is going to end at a time where earnings have come in stronger than people expected and companies are displaying a good deal of pricing power and been able to shrug off some of the geopolitical headwinds?
No, I think one big thing that's been helping the stock market is a huge record buyback. So we've seen record buybacks. That's certainly supporting stocks. When you look at it, right, in some of the past week, you saw a little bit of weakness, and then it was overcome during the course of the day with what looked like a lot like just, corporate buying. So I think that's been supportive. I think the valuation questions are still real. How much has AI driven us? Where are we headed on AI? Are we getting the benefit? All those things will start playing out, right? We get NVIDIA earnings next week. So that'll be an important part. So I think the valuations are creeping back high, setting people up for another disappointment. And that's why I think we dropped this 5 to 10%. We got down about 6%. We never got to that 10% level. I think we get there, in the next few weeks or months as this realization sets in. There's still too much hopium out there.
Well, this raises a prospect of what's the catalyst? Is it going to be economic data pointing to a more material slowdown in the consumer? Is the consumer maybe not as significant as people previously thought, which is something that we heard in an interview that Danny Berger did earlier this morning? Or is this really going to come from the geopolitics of the moment, of more tariffs, of widening pressures, of this question of whether companies can sell in China at a time where the gates are going up in the U.S.?
So my base case is that this economic weakness has been helping yields lower. That's been helping stocks. We're going to hit a point in the coming days or weeks where we see more economic weakness and people realize, wow, maybe this isn't so good for the future of the market. And that's when you start rolling over in stocks. And then you've got the geopolitical risk. You've got the made by China theory. You've got the tariffs. All of those things, I think, are almost quote unquote freebies if you're going to be short or underweight this market. I think any of those alone can knock this market down, and you potentially get multiple of those things occurring. So I think we're well set up if you want to be underweight to benefit from that. I still like yields. I think yields do go lower, but stocks are going to start giving up this whole narrative of lower yields is good for stocks and say yields are going lower because this economy is shaky and maybe even jobs aren't anywhere close to as good as the published data has been.
How much do you see a potential rally in government debt, given some of the hangovers with inflation, given the fact that we are seeing tariffs being put in place, and given the fact that the deficit, which some people worry about, some people shrug off, is continuing to climb?
Yeah, I think at the front end, we should get to 2 cuts this year. Maybe you see price in 3 cuts. I don't think we can get any better than that. And on 10s, I think we can go down to maybe 430. So I kind of have this 430 to 450 range. But as you say, you've got all these other issues. And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago. And as you look through the data, you go back through, look, a lot of the ISM, a lot of the PMI, all prices paid were much higher while the rest of the data was weaker. So, I don't want to say stagflation. I don't think that's a realistic situation, but I can't dismiss it as easily now as I could a month ago.
Just real quick, which commodity? Because oil prices haven't been really shooting higher. What are you watching?
So copper's up quite significantly. You've seen gold, the precious metals up, nickel's up. A lot of the industrial metals are actually up. Oil's been fairly stable. Oil had a lot priced in, and it's kind of been calm. Again, it hasn't really retreated, even as you've seen kind of the status quo emerge in the Middle East. So I think that's still susceptible for a shock. But really, copper's been one of the big keys that I've been looking at.
And with a 5 to 10% decline in equities, Peter, are you a buyer? Is this a buy the dip moment?
Yeah, I think so. I think it'll be a good opportunity. Again, right now, I like foreign stocks better than U.S. stocks, so I'm not completely bearish on the global economy. I like Chinese stocks, Indian stocks much better than I like, the NASDAQ 100. And I am wanting to buy banks and some of the things that have lagged behind. So some of these low valuation, high debt companies, I think they can rebound as you start getting through this. And we even started seeing in the past week or two, right, where some of the, the Russell 2000 has been doing a little bit better. So I think if we get that pullback, that's where I want to invest. I like the equal weighted indices better, but I am waiting for a pullback to get really committed.
Peter Scheer of Academy Securities, thank you. As always, really wonderful insights. Let's get to an update right now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. President Biden is set to announce heavy new tariffs on Chinese electric vehicles this week. A source says the tariffs will quadruple from under 30% to over 100% and will include other key exports, including batteries, solar cells, steel, and aluminum. Biden and his staff have spent recent weeks finalizing the measures, but the plan is seen as largely symbolic as China doesn't rely on U.S. consumers for the targeted sectors. Donald Trump pledged to double down on tax cuts if he wins a second term as president. Speaking at a rally in New Jersey this weekend, Trump said, quote, "Instead of a Biden tax hike, I'll give you a Trump middle class, upper class, lower class, business class, big tax cut." President Biden has called for tax hikes on businesses and the richest Americans. And Disney's Kingdom of the Planet of the Apes took in $56.5 million to top the domestic box office this weekend. That tops the up to $50 million projected. This marks Disney's first release of a new film in theaters this year. Its other big budget pictures in 2024 include Pixar's Inside Out 2, Marvel's Deadpool and Wolverine, and Moana 2. And that's your Bloomberg Brief. Lisa?
What's old is new again. Thank you so much, Yahira. Up next, the morning calls, plus a look at pharmaceuticals and a possible short squeeze, forcing some traders to bail out. That's next. This is Bloomberg. Welcome back. This is Bloomberg Surveillance on a week of inflation and retail sales. Interestingly, a number of guests this morning have said that retail sales more important potentially even than CPI. We could see a lift continue in the equity market after three straight weeks of gains, 52, 57, up 0.2%. 10-year yields lower by about a basis point, 4.5% rounded up, 4.48%. What we're looking at in foreign exchange is actually fascinating. And what you are seeing is more volatility in foreign exchange of developed markets, G7 currencies, than emerging markets more consistently for the first time going back to 2017. All eyes very much on the Japanese yen, the dollar bouncing back versus the yen weakening again after a surprise announcement overnight that the Japanese authorities were not going to buy back as many bonds as people previously were expecting, giving a lift to the long end of the yield curve in terms of yields higher to their highest levels going back to 2011. A brief sense of strengthening in the yen, and then boom, that reverses as well as people push back and say, ultimately, how much is this really signal and how much is this noise? Time now for the morning calls. First up, Jefferies keeping a buy on NVIDIA, but boosting its price target to $1,200 from $780. The analyst saying the company maintains control of the entire artificial intelligence ecosystem. Next up, BNP Paribas upgrading Cisco to neutral. The bank seeing limited downside for the networking equipment maker. BNP had the last negative rating on the stock. And finally, JP Morgan upgrading Novavax to neutral from underweight. The analyst citing an agreement with Sanofi to license a combined COVID-19 and flu shot. A 99% surge putting pressure on short sellers. But the stock is still far from its peak during the height of the pandemic. Bloomberg's Sam Fazeli joining us for this story and more. Sam, before we go anywhere, I just want to say, is a COVID-19 and an RSV vaccine and all of these vaccines, are they still considered any kind of benefit to these stocks, or are they basically just hangovers from an era that we're pretty much through?
Yeah, I mean, if you look at it, the enthusiasm by which people were greeting vaccine news, this is a special case, Novavax, but in general has receded a little bit. You've got vaccines that are making a huge difference, significant difference, but the reality is that expectations became so high during the pandemic that, of course, now the reality is hitting, and we're getting a little bit of what we call vaccine fatigue, unfortunately, washing into other vaccines that are absolutely necessary, such as measles, etc. So I think some of that has evaporated for sure.
Just to sort of zoom out, because we were talking about this incredible short squeeze with a 99% gain in these shares, potentially pushing away the doubters and the haters. There's a question of just how much we've seen incredible swings, incredible volatility, incredibly big bets in the biotech sphere, not like what we've seen going back several years in the face of both Ozempic or just weight loss drugs, as well as some new potential mRNA or some potential cancer vaccines as well. Sam, can you put this into perspective, how volatile this has been?
Yeah, I mean, the sector's been pretty volatile, including not just biotech, including large pharma. If you look at share price moves after the first quarter, which is what my colleague John Murphy and I talk about as how could it be interesting as you go into it, because it's only 4 or 5 weeks after they just reported 4Q. And it turns out that actually this was quite an interesting and exciting period for the large pharmas and the biotechs. The smaller biotechs continue to be at the mercy of clinical trial readouts. We had one of the big drops over on Friday in Macrogenics, which ended up losing or having a problem with one of its trials. But that is to be expected. These companies are highly reliant on the outcome of one drug or another. In the larger space, of course, obesity still rules. But also, if you look at large pharma, the majority beat in the first quarter, both on sales and on earnings per share. So there is, and most of them actually raised guidance, and some still have more room to go. So whether that resulted in a short squeeze or not, you've been talking about that. But in reality, the sector did very, very exciting moves during the first quarter, which is not normally expected.
Is it because we're just taking more drugs, or is it because of innovation?
Well, I would love it to be just because of the innovation, but frankly, good innovation, better drugs lead to more uptake, as long as the system can pay for it and people can pay for it. So, everybody looks at drugs such as Ozempic and Zepbound or Wegovy as obesity or weight loss drugs, which is not the case. If you look at the variety of clinical benefits that they're giving you, cardiovascular, sleep apnea, renal benefits, these are significant, to the point that even CMS has started talking about potentially paying for them for Medicare patients based on those outcomes, not weight loss.
I feel like this year has been bifurcated between AI hopes and dreams and the idea that we're all going to be skinny and healthier. Have we really reached some sort of sea change when it comes to healthcare in terms of both making us all thin and wonderful, and also this idea that we might be able to cure cancer with a vaccine? Do we have a sense that there has been some sort of sea change in the medical field, a breakthrough that has led to a new pace of innovation that exceeds what we've seen in the past?
Yeah, so I'm going to dissect what your question into two. Definitely seeing a new pace of innovation. The results of technology, AI and healthcare, are significantly overlapping, and that is helping faster drug development, potentially better supply chain management, and it's a theme that we're going to be following up quite closely. But the reality also is the biology, understanding of biology has evolved. But let's not forget, biology has had billions, millions, billions of years to evolve, and we're only into understanding it for about 100 years. So there's much more to understand, and whatever we think, whenever we feel like we've reached that stage of, oh yeah, we've got it, you've got to have to assume that that is wrong, and that it will throw another curved ball at you some other way.
So, Sam, before we let you go, there's been this question around distribution of some of these pharmaceuticals. Increasingly, it's online. And we have seen a number of the big pharmacy providers, I'm thinking of Walmart, some of the other drugstores, closing down their healthcare offerings, finding them losing money and moving away from that. How have you heard about that spoken about by some of these pharmaceutical companies, large pharma in particular, in terms of hopes that they could have more ready distribution through some of those outlets?
Yeah, so the issue that some of the pharmacy chains had was more to do with offering healthcare services. Maybe some mental health care services or some other versions of healthcare services, rather than what their go-to business is, which is drug distribution and drug sales at the point where individuals get access through a retail supplier, for instance. So that, I don't think, has anything majorly to do with what the pharma companies are doing, which is trying to cut out the middlemen. Now, that's not necessarily pharmacies. That's more the benefit managers, etc. So they want to try and short circuit that system where a lot of the costs that we talk about in terms of pharmaceutical gets sucked into, and that's not very visible to people. They think it's the pharma companies that are raking the cash in, which of course they are, and hopefully developing new drugs with it. But there's a lot of that money that's lost in the system to people who probably don't need to be there.
Bloomberg Surveillance, thank you so much. What we have right now in markets, the rally does continue. And just to give you some perspective on how far we've come over the past 3 weeks, in those 3 weeks of gains, we've seen about a 5% gain on the S&P 500. We've seen a 7% gain in the NASDAQ. We've seen a 13 basis point fall in 10-year yields and 2-year yields. Coming up next, Torsten Slotvold looking ahead to a busy week of U.S. eco data. A light day in terms of economic data, but that is just the beginning. We get PPI tomorrow. We get also CPI and retail sales on Wednesday. Right now in markets, you can see that lift continuing after 3 straight weeks of gains, but fading just a touch, up about 0.2% on the S&P. You can see NASDAQ futures up about 0.25% after a 7% rally over the past 3 weeks in big tech stocks. And Russell climbing just a bit more as people price out the potential for a potential September Fed rate cut. Those chances around 50% currently. In the bond space, you could see very much influencing small cap stocks. Yields lower yet again, about a 14 basis point move over the past 3 weeks or so. 10-year yields 4.48%. 2-year yields 4.84% after just touching 5% a number of weeks ago. 30-year yields of 4.63% as we parse through the push-pull of disinflation, a Fed that is patient, and the potential for the debt overhang and sales of U.S. government treasuries to potentially weigh on valuations. In the currency space, you could see the dollar just reasserting itself a bit, but really it has been trading sideways. The euro 107.97 versus the dollar. The action overnight was with the Japanese yen, but that is also retraced as we get back to the weakening trend that we have seen. A busy week of data ahead. Let's head over to New York, where Danny Berger is joined by our very own Michael McKee. Danny, I'll head it back to you.
Lisa, you've been so great on the flip-flopping of the narrative, depending on how the data comes in. So, Mike, we got to talk about whether or not we're going to get another flip-flop. Let's start with the big one. Let's start with CPI Wednesday. I saw all economists think that it will be less than last month.
Well, that's the highlight of the week, definitely. And unfortunately for the Fed, Jay Powell is speaking before CPI comes out. But yeah, we're going to take our direction from what happens with CPI. And after 4 months of having inflation go the wrong way, slightly, but go the wrong way, we're now going to have it, in theory, according to economists, starting to go back the right way. But not a whole lot, but at least in the right direction. I don't think it changes the Fed a whole lot, but you were talking about, do we get volatility? Yeah, we'll get volatility.
Yeah, if there's one thing we know for sure, Mike, it's that there will be volatility. Lisa and I were talking about this idea that rental inflation, housing inflation, for so long people have said it's a lag, it's going to show up in this report. Mike, is the lag finally going to show up in this report?
I would not make a prediction on that. The Fed is hoping so. They don't have a good explanation for why it's not. There are several explanations about the timing of rent increases and things like that. They would also, especially down at 1600 Pennsylvania Avenue, point out that the Europeans don't put housing into their CPI. And so if you took housing out of the U.S. one, we're both at about 2.4%, which would be a whole lot better than what we're showing now.
All right, set us up for retail figures. What are we likely to get?
Well, you tell me. Have you been shopping?
Not enough to save what the figures might be, Mike.
That's the problem, because we had a big month last month, and then we are not expected to have seen a big month, only 0.1% gain after 1.1% the month before. Now, this is the period where the numbers get distorted month to month because of the movement of Easter. Easter moves around a lot end of April this year, and so that pushed some spending into April that might have taken place in May that won't show up. And so it's hard to know exactly how it's going to come out, but we'll look at the control numbers, which don't show a very good performance for retail sales. But American consumers have surprised.
Yeah. Savings rate, something like 3%. Of course, it's complicated by the fact that we maybe get some more real-time data with Walmart, Home Depot. How much do economists look at that and feed it into the overall picture? For example, if retail comes strong and the companies say, actually, the consumer is concerned and we don't have pricing power anymore, what sort of picture does that leave us with?
That's what you have to do, is separate out the results from the forecasts, which is what you do on Wall Street as well. The results don't mean as much because that was 3 months ago, but the forecasts do get incorporated into people's views of what we might see in retail sales. If the retailers are saying we're not expecting sales to be good, then you're on watch for that to be a problem. And the Fed's doing the same thing. Of course, they're always talking to CEOs in their districts. You can imagine Neil Kashkari is on the phone with the Target people quite a bit, and they'll have a pretty good idea of what the companies think is coming.
Okay, Mike, this is my attempt to be controversial. Tell us why we should care about any Fed speak this week when they've all been saying nearly the exact same thing.
Well, truth be told, I can't tell you a whole lot is going to be that important. Jay Powell will be very important tomorrow because he's always very important tomorrow, but he's not likely to say anything new, particularly since he doesn't have the CPI numbers. The rest of them will all kind of line up and sing the same song from the same music, and it'll be just a matter of degree. You had Mickey Bowman last week saying she didn't think they'd cut at all. You had Raphael Bostic saying one cut, and you have others saying maybe we can cut a couple times this year. But really, nobody is talking about when that's going to happen, and so nobody really knows. It's not going to change a whole lot.
Yeah, it certainly feels like we're in no man's land. Mike, thank you so much. And Lisa, I love that from Michael McKee. The only thing we know for certain this week is there will be volatility.
Well, yeah, that seems to be the feeling more broadly. Thank you so much, Danny. Right now, with us here in D.C., we have Torsten Slok, chief economist for Apollo, who is here for the same event that I'm here for. So I'm very glad to see you. I want to start with a question we've been asking all morning, which is more important, the inflation data or the retail sales data?
Well, if you view it from the Fed's dual mandate, which is inflation at 2% and full employment, inflation is probably a little bit more important. And particularly it's important because for the last 3 months, we've seen the annualized change in supercore go up by 8%. We've seen the annualized change in core inflation go up by 4%. So the momentum in inflation in the last 3-4 months has just been moving in the wrong direction. So what's really important about Wednesday's number is whether that momentum continues or whether we're going to see indeed, as Mike and Danny was just talking about, move lower in inflation.
Why do you think from the Fed's reaction function they care more about that CPI print, which a lot of people, including Austin Goolsbee, have said is a lagging indicator, versus a real weakening in the consumer in a sense that growth is being challenged?
Well, I think the problem for them is that the momentum in inflation has just not been going down for the last several months. And if momentum has been building to the upside, we really need, from a Fed perspective, to see that momentum break. And that's the risk with the numbers this week. Shelter, there's an argument about, well, on the one hand, maybe areas of occupancy rates are looking a bit better, which would argue for shelter inflation to come down. On the other hand, Case-Shiller is now rising at 6-7% at an annual rate. So that means that we're seeing momentum actually building in home prices. So there's different parts of the scale here that are weighing, and we just don't quite know what the shelter inflation data will do. And it has been coming down a lot slower than what anyone expected. And that might still, combined with auto insurance and combined with everything that's going on in the subcomponents, still continue to put some upward pressure on inflation.
So you still see no rate cuts this year?
We still see no rate cuts. And of course, now FOMC members are also beginning to talk about no rate cuts this year. So I do think that it's just becoming more and more difficult. If you put it together in a little spreadsheet, the growth rate that we've seen for the last 30 years for the rest of this year, you will still have inflation at around 3% by the end of the year. You need a really dramatic slowdown in inflation, 0.1 for every single month for the rest of the year to get core PCE inflation back to 2% by the end of the year. So the upward pressure on inflation is just really strong over the next several months.
What we heard from Fed Chair Jay Powell a couple of weeks ago is a real indication he wants to cut rates. He is concerned about the strength of the economy. There is clear deterioration there. It seems like the bias has been more on strength than potentially that inflation read. What makes you think that's going to change, given the fact that we do see real pressure that's coming through with initial jobless claims, with consumer confidence, with the fact that people definitely are feeling something that's coming through in the numbers?
Oh, absolutely. And that's why to retail sales, it is also important. It's not that inflation is the only important indicator this week. Retail sales does play a role. What is interesting is if you look at the Bank of America card data, both for debit card and credit cards, it actually showed, surprisingly, where they show across the income distribution, that there was actually a fairly significant bump higher in spending for both low-income, middle-income, and high-income groups in the month of April. So there's a number of different indicators that are pointing in different directions. We do see, to your point, delinquency rates go up, in particular for low-income households that are younger on auto loans and credit cards, and student loans also have been seeing some pressure. But the bottom line still is that let's see what the data gives us, because overall, yes, the latest non-farm payrolls was a little bit weaker. There were two reasons why that was slightly weaker, but the conclusion still is this economy is not falling apart. It is still a fairly solid growth rate that we see over the next several quarters.
We've been talking about the flip-flopping narrative. We had no landing for a lot of this year. It's been flipping and flopping depending on the day, sometimes in the same day. Then we got to Goldilocks, and that seemed to be where everybody was at for about a couple weeks. And then now people are talking about the potential for a hard landing due to economic weakness. It sounds like you don't disagree. It's just later than people expect, and it's not soon enough to keep the Fed from holding rates where they are. Is that correct?
I think that is correct. But I think that the tailwinds to the economy that are still behind us, two things, namely, we still have behind us a very strong tailwind that comes from easy financial conditions. The stock market is up $9 trillion since the November 1 FOMC meeting when the Fed began to talk about rate cuts instead of rate hikes. And on top of that, we also have a tailwind from fiscal spending. We still have strong spending in the pipeline from the CHIPS Act, Inflation Reduction Act, the Infrastructure Act. Those two things, easy financial conditions and easy fiscal policy, which, by the way, is very different from what's going on in Europe. But those things are likely to continue to give us fairly robust data, at least for the next several months, and most likely even all the way through the end of this year.
Stifel just put out commentary that seemed to agree with what we heard from Peter Scheer of Academy Securities earlier. They said the next 500 points for the S&P 500 are going to be down, talking about a 10% correction, similar to what we heard from Peter. Why do you disagree that there is enough ammunition for things to kind of hang in there and even creep higher, even as people really do wake up to real risks that we're seeing with respect to spending?
Well, I think this is a really important question. So the risk from higher for longer is two things. Higher for longer on its own means higher debt servicing costs for companies. That should argue for stocks going down and credit spreads widening. The problem is that the reason for higher for longer is that the economy is good, meaning earnings are good, GDP has been strong. So as a result of that, we should expect stocks to go up. We should expect spreads to tighten. So there's a tug of war between rates higher for longer is hurting, so to speak, in the CFO's office when debt servicing costs are having a negative impact. But if that's happening because the economy is good, I would still expect the economy to do just fine for the next several quarters as a result of the tailwind of the stock market going up, easy financial conditions, tight credit spreads, and also fiscal policies still providing quite a tailwind.
Does that mean that there's going to be a bigger downside on the other side?
That does mean that when we're looking to 2025, I do think that we'll set ourselves up, because think about the following, exactly as you're saying, Lisa. The fact that we have delinquency rates going up on credit cards and auto loans even in an economy where everyone has a job, the fact that you have highly levered companies in venture capital, in tech, in growth, enterprise software that are highly indebted and experiencing a lot of problems, that these problems are still here, even in a good economy. That tells you once people do begin to lose their jobs, once the economy does begin to slow down, you already have a lot of distress, including in commercial real estate. There's a lot of office problems, obviously. Imagine what the problems will look like if you finally get the unemployment rate to move higher. So therefore, the sensitivity next year is that we might actually get a risk of a harder landing coming back. But that's not the theme for the next several quarters.
Meanwhile, you keep mentioning the fiscal overhang and how much that's going to be funding things. It is the reason why we're here. We're going to be speaking on a panel talking about the fiscal debt and how much that's really going to be a problem at a time where Steve Eisman came on and said, the deficit people have been worrying for the past 30 years, and they've been wrong and wrong and wrong. Why is it different this time? Well,
because all the literature and all the papers that look at financial crisis and debt crisis, they do show that if you eventually keep on growing your debt levels up, and they just keep rising, and the CBO, the Congressional Budget Office forecast is that we basically go from 100% of GDP debt levels to 200% of GDP debt levels. Ultimately, it does try to stress the system more in terms of three things: what's happening in treasury auctions, what's happening to ratings, meaning sovereign ratings, and what's happening to the term premium. So that's why in financial markets, we should be watching auctions, which we do every week. We should be watching what's happening from the rating agencies. Will we get another sovereign downgrade of the U.S. from some of them? Moody's still has AAA. Fitch has been downgrading in August. So that's really important. And the third thing is the term premium, which you can find on your Bloomberg screen here, has also been trending high in the last 6-9 months. So the stresses are slowly beginning to emerge. So far, most auctions are going fine, but investors should absolutely be keeping an eye on this. This is something that's just a bigger and bigger risk in the background.
You have some incredible statistics in terms of the amount of debt that's going to mature by the government, $8.9 trillion over the next year. You talk about an average 12% of government spending is currently comprised of debt servicing payments. And we're talking about a lot of people who are still dismissing this in terms of a major risk. What do you think could be the catalyst? At what point do you say to people, you can dismiss it until you can't? Is the election something you're watching?
Well, I would say that if you think about this from a corporate perspective, when debt levels go up, for a long time, it doesn't matter in most cases, and certainly it does matter. So the fear you can have, exactly as you're highlighting, that the rollover of existing debt is roughly around $9 trillion. Then on top of that, the budget deficit, in very round numbers, is about $1 trillion for the next many years. So that brings us to $10 trillion. And then, by the way, the Fed is still doing QT, which adds a few more $100 billion. So it brings you to more than $10 trillion that need to be refinanced in the next 12 months. So that's roughly a third of GDP. If we do continue to see more spending, and if we do continue to see budget deficits as far as the CBO continues to forecast, then I do think that investors need to watch very carefully what's going on, again, with auctions, what's going on with rating agencies. Are they downgrading the U.S.? And finally, what's going on with the term premium? Because that's where the stresses in financial markets will first begin to show up.
So put you down as the deficit, one of those in that camp.
Absolutely.
Torsten Slok of Apollo, thank you so much for joining us. Very much enjoyable to hear your point of view. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Haqqis. Yahira.
Hi, Lisa. Apple is nearing an agreement with OpenAI to use the startup's ChatGPT features on the iPhone. That's according to people familiar with the matter. The move would be part of a flurry of new AI features that Apple is planning to announce next month. The tech giant also held talks with Alphabet about the company's Gemini chatbot. Those discussions are ongoing but have not led to an agreement. Tesla is facing further protests at its factory in Germany, where activists are trying to stop an expansion that would require clearing part of the surrounding forest. Police say at least 16 people were arrested on Friday following actions, including breaking into an airfield, damaging new Tesla vehicles, and blocking a road by the factory. And campus protests over the war in Gaza are colliding with college graduation season. Comedian Jerry Seinfeld was the commencement speaker this weekend at Duke University, where about 30 students walked out, chanting Free Palestine and waving flags when he was introduced. But Seinfeld didn't address the protests. Meanwhile, Harvard has signaled administrators are losing patience with protesters who have set up tents at Harvard Yard, where a commencement ceremony with more than 30,000 people is scheduled for May 23rd. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Archegos founder Bill Hwang facing life behind bars.
We're very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes as well.
That's coming up next. You're watching Bloomberg. About 41 minutes until the start of the trading day, we can see that stocks want to rally further after 3 straight weeks of gains, up about 0.25% on the S&P. It's where they've been all morning. It's no drama this morning. You can see yields lower a bit more so, down almost 3 basis points to 447. Looking ahead to Jay Powell tomorrow, and then, of course, to PPI tomorrow, as well as CPI and retail sales on Wednesday. Under surveillance this morning, Archegos founder Bill Hwang facing life behind bars.
We're very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes as well in order to get the lessons learned out and make sure it doesn't happen again.
Here's the latest opening statements in Bill Hwang's criminal trial starting in New York today. Hwang is facing fraud and market manipulation charges. He'll be tried alongside former Archegos CFO Patrick Halligan. Bloomberg's Sonali Basak joining right now with Danny Berger in New York with the latest. I'll hand it over to you, Danny.
Thanks, Lisa. That's right. We've got Sonali before she needs to head out to a very cold city where she'll be outside of the New York courthouse. So, Sonali, this was 3 years ago, so I think we might need a little bit of a refresher on what these trials, what the charges actually are.
Remember, the trial of Archegos is really surrounded by what the U.S. has brought forward as a racketeering conspiracy, wire fraud, securities fraud. He was sued separately by the SEC as well. But when we think about this trial in particular, a lot of these counts, each of them could be 20 years in prison, potentially life. We don't typically see that, as you know, but it will be a contentious trial as we believe it. We have seen the defense already come forward, starting to fight a lot of these charges put forward to them. What exactly is the prosecution trying to show here? This idea that Bill Hwang and his deputies had looked to defraud market participants by manipulating and affecting securities prices through amassing swaps in those positions. If you remember, large stakes in companies like Viacom, CBS. They're also trying to say that they convinced counterparties to trade with them and provide them credit based on misleading information. So we may hear a lot from counterparties throughout the course of this multi-week trial.
Just hearing you talk about this, Sonali, this is obviously a complicated topic, as many white-collar trials tend to be. What does the jury look like? Are they the types of people who are set up for this sort of thing to understand even the language that the prosecution is going to be using?
I'm glad you asked that because, of course, there was that jury selection process, and there were people in that process who were very familiar with Archegos, one private equity executive even saying, and of course he was not part of the final jury, that a friend had lost money in the course of what happened with Archegos. So the final jury, you do have some people with exposure to the financial system. You have a software engineer from Bank of America, for example, but then you have others like a former train inspector for the New York Department of Transit. You have a former clerk on the New York Stock Exchange. So quite a colorful jury in and of itself, some with some exposure to finance, but even the judge said that for them, this will be a finance 101 course in many ways as they learn about this market.
Probably better than you could get in any classroom, given the topics they're going to be discussing. Sonali, you mentioned what the prosecution is likely to say. What is the defense likely to say to defend?
Well, one important thing here is that did they break the rules in and of itself? If you read the initial indictment, it is pretty interesting here, Danny, because you do have an acknowledgement at the very beginning that this is an opaque market where there were not rules around the disclosure around some of these products. That's one thing. There's another element here. One thing that I think a lot of people in the market are curious about is Credit Suisse's role, the different banks' roles. Remember this idea that some of Credit Suisse's own risk management practices may have been flawed from the beginning, may be a point of contention between the defense and the prosecution here. So throughout the course of what we'll see here, remember, two of his employees, his former employees at Archegos, have already pled guilty and are expected here to be testifying during some course of the trial. As far as today goes, you have opening arguments, but you may see witnesses being brought forward from the beginning, including somebody who had worked at UBS, who was at the other end of the calls for Archegos. And so we're going to get into it pretty quickly here as the week goes on.
Yeah, because before you came on, Sonali, we were listening to Ralph Hammer speaking in 2021 when he was the CEO of UBS. How things have changed. I mean, you can see it right there that he's not there. But 3 years on, has anything actually changed on Wall Street to prevent something like this from happening again?
I would say marginally, because you did see the SEC, for example, come forward with new rules around swaps. But have they gone far enough? Remember, a lot of those rules were tied to the initial Dodd-Frank post-2008 regulation that just was implemented kind of late. And so the idea that certain of these actions could be perceived as illegal in the first place, that is being addressed. It's been addressed to some degree by the SEC. Now, you did, in the immediate wake of Archegos, remember, Danny, they had so many conversations inside of regulators about whether this would require more disclosure from family office vehicles. And that we have not seen happen. Now, will this trial inspire that conversation to begin again is a major question. The CFTC has looked at it, and so have other regulators. Will that become a bigger issue moving forward?
Sonali, thank you so much for joining us. That is Sonali Basak and Lisa. Sonali's going to head down now to the courthouse in New York. A busy day here on Bloomberg TV.
Hopefully with a sweater on underneath her blazer. Thank you so much. And thank you so much, as always, for today, Danny. Coming up later today, do not miss this. Annmarie Hordern sitting down with Treasury Secretary Janet Yellen as we prepare to hear from the Biden administration on tariffs on electric vehicles coming from China. Bloomberg's editor-in-chief, John Micklethwaite, interviewing French President Emmanuel Macron at a time where he's being pitched by everyone under the sun. And speaking of which, our own Jonathan Ferro speaking to Goldman Sachs CEO David Solomon for a rare interview as he sits down in France to try to get an upper hand as potentially Paris lobbies to be the next London and the next financial capital of Europe. Coming up tomorrow on Surveillance, Brian Levitt of Invesco, Franklin Templeton's CEO Jenny Johnson, former National Economic Council Director Gary Cohn, at a time where very much the focus is on what a budget under the former President Trump would look like in a Trump 2.0 administration, and Chris Marenghi of Gabelli Funds. We do see a lift to markets. People want to feel good in the push-pull of ping-ponging narratives, whether we get that sort of emphasis on retail sales, whether we get it on CPI. That all comes up on Wednesday, with Jay Powell thrown in the mix tomorrow, speaking on a panel. This was Bloomberg Surveillance from Washington, D.C. Have a good day.